Hi, everyone. I hope you're doing well. I think we're live. We are live. Okay. Thank you all for showing up and taking your time out of your day. What I wanted to do is just keep in touch with you guys, explain sort of what our high-level view is, some of the target companies, what we're looking at, some of the recent changes in the portfolio, and then sort of any sort of Q&A that we get. And the more regular, I guess, we do this, I guess the shorter they will become. The first couple were, I think, about 3 hours long each. So let's get straight into it. I just want to give a little bit of a refresh of the high level view of what we believe is essentially going on. Then we'll go into target companies that we're looking at, how we're addressing that high level view, and then we'll explain through the recent acquisitions and how that ties back to essentially what we're looking for. So our high level view, very simple. We've gone over it a number of times in a little bit more detail in some of the previous live streams. But essentially our view is that, look, the consumer will outlast the US government. And the reason being is net cash. We're now at a point where inflation is coming down. It's gone from 9.1% down to 6.4% on the latest print. Wage growth still stubbornly high. In the next couple of months, we're going to start to see net positive real wages reemerge. You're probably going to see the flow of savings improve. And so the consumer is actually in a reasonably good shape going into a slowdown in growth. We're not negative in growth, but a slowdown in growth. US government's a very different animal altogether. Tax receipts are actually starting to slow down. And you can see, even in California, more specifically, California, for those of you that don't know, California is the same size in terms of population as Canada. It's actually bigger. It's 39 million, I think, population versus 36 in Canada. Just to give you an idea of the size of California. Tax receipts, I think we're down something like 40%. So government tax receipts are down. Why? Capital gains tax, right? So if asset prices are not increasing, nobody's paying capital gains tax. So a big reason why California's tax rates were down so much is no capital gains tax. Markets didn't perform very well. Any market didn't perform very well last year. So there's no tax income there. So you have a situation where debt levels are very high and your US government are, well, each state's going to be different. And then the federal government at large is likely going to see a slowdown in tax receipts. So your income's going down, but your interest expense is going up. So the consumer, our view, is going to outlast the US government if we are persistent, which is not likely to happen. There is an arbitrary question as to how much liquidity is in the system. Is that 6 months, 12 months, 2 years, 3 years? There is an arbitrary question as to how long is there, because we've got the TGA, we've got obviously issuing more coupons, dragging out money out of RRP. There is a couple of financing tricks that could get the US government by in the near term, but we know there's a ceiling to that. And so the consumer is likely to outlast the US government. And we've seen that over the past year. If, God forbid, you said in June last year that the US economy was strong, you would have been torched at the stake. And here we are. We're in February. People are very surprised that we're not in a deep 1929 style crash. Inflation likely stays higher than rates for the next decade, net. That doesn't mean we're always going to have higher inflation than interest rates. You go back to the 1940s, inflation got as high as 20%. It dropped as low as -2%, got back up to 16%, dropped back down to -2%. But on average, inflation was a lot higher. The only way the US government can get their debt levels down without defaulting is by increasing taxes. So you can very regressively increase taxes, or there's also another regressive tax called inflation. Why? Tax receipts coming in for the US government are a percentage of goods and services. So if the price of those goods and services continue to inflate, so too does government income. So inflation is part of the solution. So we believe that inflation likely stays higher than rates net over the next decade, and therefore cash is trash. Now, if you need cash in the next month, 2 months, 3 months, cash is not trash. But if you're saving for your retirement 1, 2, 3 decades into the future, cash is likely trash in that scenario. You want to own assets, because with that inflation, that's nominal earnings. Asset prices should appreciate on average over the next, say, 5, 10, 15 years, if our thesis is right. So that's a high level view of what our thesis is. And then the next question is, what are our target companies, right? So this is another sort of high level view. So the first question we've got to ask ourselves, who's the natural buyer of the company we're invested in? So if you go back over the past decade, it's largely been sort of leverage within the system, margin that continued to expand, and with higher margin came higher stock prices. We're in a situation where we'll see inflation above interest rates for on average over the next decade, but we'll see interest rates off zero. So net leverage within the system is probably going to be a lot more moderated than what it was over the past decade. What does that mean? Well, the natural buyer, who's going to be the natural buyer of that stock? Do we have to be dependent on low interest rates and leverage? No. The company themselves can actually be the natural buyer of the stock. We went over this sort of over the past couple of live streams as well, where a company could do large scale buybacks, or if they're heavily levered or heavily geared, they could pay down their debt at a discount. A lot of corporate debt's at a discount right now. So you can buy back your corporate debt at a discount. And if, let's say, the enterprise value to EBITDA is 10 times, and you've got an equity valuation plus debt minus your cash, if you pay down the debt, well, the equity needs to re-rate higher. So by paying down debt in a levered company, or by doing stock buybacks, the company themselves are the natural buyer of the stock. Now, we need to look for companies that have non-discretionary revenue, which is important. Now, non-discretionary doesn't mean non-cyclical, and a lot of people make that mistake. Non-discretionary means it can be cyclical, absolutely, but for argument's sake, we look at a company, a target company for us, which is Lumentum Holdings. They provide specific products for argument's sake, the industrial sector. Those products go into tools to make final products. It's like if you were in a warehouse and you had this warehouse running 24 hours. If a light bulb blew, you have to replace the light bulb, otherwise you can't see anything. And so the light bulb is non-discretionary expenditure. Now that can be cyclical for sure, but it's non-discretionary. You got to replace the light bulb when it blows in that factory. And so we're looking for non-discretionary revenue, with the company being the natural buyer, either through consistent debt reduction or buybacks. Not really interested in dividends, not very efficient, because it's double jeopardy on tax. It's double jeopardy in the sense where the company itself is going to pay corporate tax. They're going to distribute it back to us in the form of a dividend, and then we pay income tax on it again. Whereas a buyback, okay, there's going to be a 1% tax, but it's still more efficient. A buyback is very much tax efficient because you don't get double jeopardy on the tax. Right, so the company comes in, that pays their corporate tax, they use the cash to buy back their own stock. I don't end up paying tax on that, but I do get more ownership in the company. And provided it's a good company, the share prices should react. And so that's essentially why we prefer buybacks. Not really interested in dividends, but there are companies like Medifast in the portfolio that are literally stuffing the mattress with cash. Very asset light, very profitable business. They're doing 150 million buyback, not a big business. They're also paying out 5.6% in dividends. They just increased their capital expenditure from 5 million to 40 million, and they still have 60 million in the bank. Not a big business, very profitable, fantastic flywheel going on there. They pay a dividend, but that's not why we own it. We own it because we believe that the equity at 9 times earnings is too low, and the buyback's going to be the natural buyer if we don't get that leverage increase. And then growth is also a factor, of course, right? So there are certain industries that is going to see growth over the next decade. There's probably going to be quite a few industries if we dig our toes in and do a little bit of hard work. But growth is also a factor. But we want to reduce that risk by looking for undervalued companies, natural buyers to the company itself, sentiments in the gutter, some degree of non-discretionary revenue. And that should be a hedge against higher inflation and should give us a real return. That's really what we're focused on. So the recent actions in the portfolio, I want to line this up with, let me just drag this over. There is some comments here, but there's a lot of comments of stuff that I'm going to go over. So Warner Bros. Micron, I'll talk about that a little bit later. Overstock, I've got a couple of comments on Overstock. We'll talk about that later. There is a question on, so there's a question, well, I thought there was a question on Jack in the Box, which is at the very top. That's why I want to start off here. Why did I close Jack in the Box? I think the question was. Show more comments. Sorry about that, guys. Here it is here. So a few questions. Okay, that just came in the door. Anyway, there was a question about closing Jack in the Box. All right, so let's just go over that anyway. It is one of the questions. We'll go through these anyway with a fine comb in a moment, but I'll start off with that. All right, let's start off with Jack in the Box. Jack in the Box I sold. So if you guys want to see that, you will go over to my profile, portfolio, history, close out Jack in the Box, and I close out some Meta, which I'll talk about in a moment. So I closed out some Jack in the Box on Friday, and the question is why. I always intended for Jack in the Box to be a shorter term position. It had everything going for it. So let's just talk about the business, because as you can see here, business model is very easy to understand, and at the right price, I'll absolutely be back involved in it, but the margin of safety just doesn't exist there today. So let's pop on over here and let's understand what the opportunity actually is. Let's zoom out here for a moment. You can see that there was an acquisition that was made, and that's part of the opportunity that exists here. So this is a company that bought another company called Del Taco Restaurants. I kept calling it Tex-Mex, but it's Del Taco. Del Taco Restaurants. Now, Jack in the Box is over here. This is all Jack in the Box, and this here is Del Taco. If we go down to the bottom here, what you'll see is there's 290 company-operated Del Taco restaurants, and there's 301 franchise Del Taco restaurants for a total of 591. Jack in the Box bought this company for $585 million, increasing the debt levels. Market was very worried at the amount of debt that they were taking on. This is the genius, I guess, behind management. It's not really a restaurant brand. And the reason why I say that is, here's Jack in the Box, company operated stores, 146, franchises, 2,035. It's not really a restaurant brand. It's a service provider. And so if we pop on over here, you'll have a look at the return on capital, return on invested capital. It just continue to grow and grow and grow and grow year in, year out since the trough in after global financial crisis. Just continue to grow, got more and more and more profitable as they continue to franchise restaurants and become a service player. More recently, it dropped pretty aggressively, a couple of acquisitions. Why did it drop more aggressively? Well, part of it was inflation, of course, but also the acquisition of Del Taco restaurants. They've got far more. They've got 3 times the number of company-operated restaurants. Why did they buy it? Well, they're going to spin off some. And I think the plan, what management were saying is they're going to ramp it up very similar to Del Taco restaurant or Jack in the Box. More and more and more franchise. That's their core competence. They've got a pretty decent track record of being very profitable. Yes, there's a lot more debt. Yes, there were challenges with wage costs. There was challenges with food prices, commodity prices. But they also had a change in mix in terms of the revenue, and that was part of it. So we had a situation where we understood the business fairly well. MasterCard's credit card spend was coming out. January was 24.1% for restaurant spend and 14% in December. Very, 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 very high restaurant spend. As of right now, consumer continues to spend a lot more. What does that mean? Upgrade in terms of expected earnings. What does that mean? Expected value should have a tailwind. And so the opportunity in Jack in the Box was very simple to understand. They bought Del Taco, ramp up the franchises, become a service provider, focus on your core competence, normalize your margins, get your growth, get your return on invested capital up. And that's essentially what the opportunity is. Now, in tandem with that, we had a situation where technicals were also lining up. So the technicals were lining up in a sense where this year moved sharply off the lows, and then it broke down in what's known as an A, B, and a C, which is a corrective structure, which could be a wave 2 or a wave B, or in this case, I'm thinking it's more of just a wave A. Anyway, from this area, which was a 1-to-1 perfectly, which is normally what you get for an A and a C, from this area here, that's where we purchased it, there was a fantastic technical setup. There was also an opportunity where we fully understood the business, and at the same time, there was also a margin of safety. So if we have a look at Jack in the Box, Jack in the Box is, where is it? There. Jack in the Box was coming out at a fair value in the 90s, about $95. So it was about a 30% discount or so in the fair value. Why did it come down to 81? Well, part of the reason was huge amount of debt, and the risk-free rate went from 3.5% up to 3.82%. So as of right now, the expected return based on the present value of cash flows out to 2027 is 7%. So why did I close it? I just didn't think there was a margin of safety there. As well as that, when I'm looking at the chart structure, this here is also up in 3, down in 3, and then up in 5, which is a smaller degree A, B, and C. So based on the present value of cash flows, there just isn't a deep enough margin. Neutral rates increased, meant that the upside is probably going to be capped. It delivered 17% in 2 months since we bought it. Everything was just in a row, and I was quite happy to put the position on, knowing that it probably wouldn't be for a long period of time, and I was equally happy just to take it off. Now, if this ends up playing out something like this, and we do get down to lower prices, I'll absolutely buy the company again. Reason being, It's a very profitable business. Because of the nature of the business, there's just no margin of safety. So we get a deep enough margin of safety, good quality brand, reasonably good management. It's a service provider as opposed to a restaurant operator. And if we get it at the right price, it'll find its way back in. But, you know, certainly after last year, there's a lot of things that I feel like I could improve on. And this is certainly one of them, being a little bit more cutthroat when it comes to taking profit or recognizing when something is probably changing, just being a little bit more proactive. So before, I probably would have left it as it went lower. I probably would have added more. But last year, we carried over a 22% unrealized loss. Last year, the performance was negative 26.5%. Added funds in May when we were up 4.4. So that's why it shows up 28. So we had a real loss last year of about 4%. Due to tax loss harvesting in December, we were able to carry over a 22% unrealized loss. So we can make like 23, 24% this year, harvest those losses from last year into the end of the year in order to be a little bit more tax efficient this year. So again, those reasons are, it depends on your local tax region, how they tax that. But certainly where I am, I'd be able to offset even short-term gains against losses. And that's ultimately how I'm playing it. So where we are with Jack in the Box, it was an opportunity that presented itself. I thought it was going to be a little bit longer than 2 months. I thought there was going to be a lot more upside than I think it was 17% or 19.3%, I think is what it was. I think it was not, yeah, it was 19.3% on average. So I thought it was going to be a little bit better than 20%, but look, it is what it is. So that's why I closed out Jack in the Box. The second decision that we made was Meta. Why did I cut the position in Meta? Well, I was in Meta. I normally in that case, like if you look at all the positions that we took, I'll use Crocs as an example because Crocs is kind of similar to Facebook at this point, just Facebook's a little bit earlier on in the journey where it gets absolutely punished on the downside. It never should have traded at 4.4 times, but that's an opportunity to add some more. And provided that the execution and the fundamentals of the business don't change, it's irresponsible for us not to average in to a good quality company that's fully operating that just gets cheaper. The opportunity is bigger. And so we bought into Crocs at $100 and we bought the whole way down, bringing our average cost down to 74. We continued to add to it because the fundamentals didn't change. And then when it starts to rip higher, look, if we didn't add anything year over year, the performance in Crocs was being 31% based on the initial position we took. $100 was the average cost, but we bought more in the 70s. We also bought more at 46 or 50, something like that. I'm not sure. But we bought the whole way down. So the expected return increases massively because the valuation got cheaper, but the fundamentals didn't change. Meta's a little bit different. Meta's a little bit different in that the fundamentals did slightly change. If you guys remember, it was this drop here. So I added more because fundamentals were still fine in around 130. I think it was around 134. The last time I added, it should be there anyway. If we have a look at Meta, I did add some current position, but where did I add? I did add some at 140. Okay, so I added some at 143, which is in and around there somewhere. I was adding it, and then earnings came out and it dropped massively. The reason why it dropped massively is, and this kind of caught me off guard, the increase, there was an increased capital expenditure by almost 10 billion on the high end for the following year. And the problem with that is we already had I think it was $28 billion, $29 billion in expected capital expenditures. The expectation increased to 38 billion on the high end. That's a big increase in capital expenditures. And here's where the problem was. And this is why I didn't add more. I absolutely regret it now, but despite it looking like a fantastic opportunity, there's two classes of shares. Zuckerberg, who I have 100% faith that'll not just turn the business around, but you can already see from the performance of the equity, it's doing very well. A lot of good decisions, bringing out new features, also cutting back staff, increasing capital expenditure, increasing free cash flow there. But I had a lot of faith in them. But there's two classes of shares and all the voting rights. Zuckerberg pretty much has all of them. And it was that unexpected announcement of increasing capital expenditure on the high end by 10 billion after announcing layoffs. His communication was really bad, and it worried me a lot. Look, I would have added even more, but it is what it is. When you figure out what the present value of cash flows are, this was screening out way higher. But when you factor in that the cash flows, the unlevered cash flows are way lower because the increase of capital expenditures, the fair value of the company it comes out to be a lot lower. It comes out at about $219. So I reduced exposure, and I reduced exposure. Where was it? I don't know the exact prices. I reduced exposure in the ballpark of 190, and the reason being is we were getting closer to fair value. We were up in 1, 2, 3. 196 was a 1.618 extension, and I wanted to take a little bit off the table, get paid for the risk that we've taken. I say get paid for the risk we were taking. We were only close to fair value at that point, but the expected valuation came down massively. From a technical perspective, it looks like this is a wave 1, 2, 3, 4, and 5. So I am expecting to fully get out of the position on a move up towards about 220, 230. Wait for a correction. That's a pretty damn decent move from 88 to over 200 if I'm right. So we're likely to see a little bit of profit taking. Correction on the downside generally happens. And I 100% intend on opening this position again, but at a much better cost basis. So with Meta, I got into it before the capital expenditure just continued to get out of control. Now we're at a point where there have been layoffs. Zuckerberg's on record of saying Facebook is a company that have managers, managing managers, managing managers, managing managers, managing managers who manage the people that do all the work. And he already has it on record that a lot of those middle management are about to get chucked out the door. That's after the layoffs we've recently seen. So in the latest earnings call, which we've seen this big jump here, the word efficiency, this is the year of efficiency, was used, I think, something like 25 times. So we're seeing a completely different Facebook than what the market's seen over here. Was a little bit dicey. I do regret not increasing the position 100%, but you win some and you lose some. And in this case, I already had a position, but it is what it is. So that's why I reduced it. Don't be surprised to see it gone from the portfolio, but it will be back at some point in the future when the margin of safety opens up again. Remember, we're calculating the present value of cash flows over the next 5 years to be $219. Can you guys see that? $219. And if this chart pattern is correct, we've got 1, 2, 3, 4. The fifth wave will come in somewhere in and around that ballpark, and I'll be happy to take profits. A little bit of divergence. Usually when you have this overbought, from a technical perspective, when it gets this overbought, it's usually a prerequisite for higher highs. You put in that divergence, slow down the momentum, and the move is pretty much done. So that's all showing up at the moment. So that's what I'm looking at with Meta. Next decision that we made since the last was to close out of Charter Communications. Now let's just scroll up here. We're looking for companies with interest. We're looking for companies that are going to buy themselves, literally cannibalize the stock. Charter Communications is a company that's doing levered buybacks. They're remaining at 4.5 times net debt to EBITDA, and every dollar that comes in is levered up, and they're buying back the equity, and that's what they've been doing. As of right now, the question is, I think it's a CHD, I think it's a $100 billion company, or 50 billion and then 100 billion in debt. So it's 60 billion as of right now. So as of right now, it's a $60 billion company with $100 billion in debt, bringing in about 4.5 billion in free cash flow, 5 billion in cash flows. So that 5 billion in cash flow now has to go towards levered buybacks. And that was really what the opportunity was, where if they didn't lose subscribers and the revenue was just flat, they'd just be able, like a windmill just constantly sucking up shares. They just continue to buy back shares, and the equity price would be supported and push higher at a reasonable multiple. The problem was on the latest earnings, I didn't realize just how leveraged the company was. They had an increase. I can't remember the numbers right now because there's a lot of companies I follow, but I think it might have been 43. Was it 40 or 80? I'm not sure. Something like 43 or 40. No, I can't remember. It was a decent amount of net new subscribers. I think it was 80 something actually. It was a decent amount. They were heavily discounted. And the problem is if those customers, those new net additions, if they actually go out and churn in 6 to 12 months because that that promotional deal that they got rolls over, it actually costs them money to acquire those customers. Expected earnings are gone down in anticipation of that. Now, it hasn't played out yet, but expectations moving forward are that there's going to be high churn on net new subscribers, and the massive marketing and promotion is going to cost them money. And so when you actually change out the new EBIT forecasts and you increase capital expenditure, remember these guys are spending $100 per subscriber on capital expenditure, an increase. It's about $1 billion, $1.5 billion or something like that per year for the next 4 years. The numbers come down to a point where the fair value is somewhere around $450, something in around that ballpark. But it was the massive change from an expected value of 700 down to 450. And the reason why that change occurred is the leverage, right? So when there's a small tweak to the earnings, think of it like this. If you had a 10x leverage position in the S&P 500 and it goes up 1%, you just gained 10% of your entire portfolio. Huge amount of leverage, massive outperformance in your returns. But what's the problem with that if it goes against you? Massive downside risks. And that's one thing, when I was looking at the business, I was like, I didn't realize the leverage was as big as it was. When you see those sort of marginal changes, it has a massive impact on the present value of cash flows. And for that reason, I think we were up 13%. If we were at break even, I would have got out. Just the shock of seeing the big, massive change from a small impact to forward guidance. Kind of caught me a little bit by surprise. We took a little bit of a gain, but in recognizing the leverage in that business is probably a little bit too much. If you look at something like Warner Bros. Discovery, same type of levered play, but they have about 7 billion, 8 billion in unlevered cash flows once it normalizes. The equity valuation is somewhere in the ballpark of, I think it's 37 billion after a pretty decent run, 37 billion and 50 billion in debt. So if you look at the combined business, just debt, equity, you're up about 80 billion, 90 billion, and you have cash flows of 7, 8 billion. That works. It works really well. Doesn't work as well with Charter because the debt was 100 billion or 98 billion, and then the equity is already 60 billion. It's just too much leverage. And in recognizing that, very grateful for a gain, but hard pass. Baxter is one that's recently been bought. I'm looking to increase the position even further. I'm very excited about Baxter. There's a lot of sort of misinformation, but there's a huge opportunity in Baxter. What I like to do is find like Joel Greenblatt says, if you do the valuation work right, he can't promise when the market will agree with you, but eventually it will. Baxter's company is a high quality, it's a really, really, really high quality business that has a couple of different revenue centers that's kind of been mismanaged. Bringing in Hillrom, brought scrutiny from, I think actually the DOJ. There was scrutiny from the DOJ, but there was certainly scrutiny from the FDA regarding the hospital beds. A little bit sloppy. And then with inflationary pressures, the other revenue centers were being managed by one individual, so that wasn't very efficient. Share price got absolutely hammered. It's down 50%. This is a high quality company, again, with non-discretionary revenue that in the past year inflation hit them, a bad M&A deal hit them. And the question is there a decent opportunity? I've got a little write-up here. The question is there a decent opportunity? And the answer is absolutely, in my view. So they're looking to restructure the business into 3 different sort of revenue streams. What they call them is global business units, GBUs, global business units. So you got 3 global business units, and then you got a SpinCo, which the spin-off company, which would be the renal care. And that's going to be an individual company, going to be spun off in the next 12, 18 months, and will get shares as a dividend for that individual company. Now, when you add up, so why are they doing it? Upstream and downstream commercial operations will be combined with P&L accountability. So right now with inflationary pressures, there's bloated staff, people are like, it's just not very efficient. So the idea is each revenue center will have its own head who will be responsible for the P&L, which includes up and downstream operations for organic growth, acquisitions, all that type of stuff. They'll be responsible for capital expenditures for the business. So you're seeing a 5% reduction in staff. It's a little bit too bloated. And because it's going to be more microscopic focus on expenditures, it creates this opportunity where you have this fantastic business that's not really performing very well, but with a little bit more attention, You're going to be able to normalize margins. Profitability will increase even if the top line doesn't grow. It's a great prospect. And at the same time, you get these shares in the renal company. So you got to look at the valuation of the cash flows in these three different companies, plus what the expected value of the renal co will be once it spins off. And so that's essentially what's happening with Baxter. I think there's a fabulous opportunity here. And so when we have a look at when we have a look at the fair value of Baxter, Baxter as a company is worth about $95 using the average multiple of 12.7 to come up with the enterprise value to EBITDA. But most of its valuation is deriving from the perpetual growth rate model for its terminal value, which is way higher. So if we're looking at perpetual growth rate, if that's more so looking at its cash flows, it's worth $115, excluding the renal co. And if we're looking at enterprise value to EBITDA using the average multiples, using about 80, it's worth about $80, excluding the renal co. So in both circumstances, 95% on the upside on the lower end, 180% on the upside on the higher end, just for those three divisions. What's excluded out of the future cash flows is the renal co. So the renal co is going to be about 4.4 billion, does about 500 million it does about roughly 500 million in bottom line income. And if you slap on a 12x multiple, which is the average for the company, it's about $6 billion. So we have to add that back in. What I decided to do is, because the multiple can change at all times, I just decided to pop on over here, take the renal co, assume like 15% of the entire enterprise value of the business that's currently existing. You're getting a target about 110, including the renal co. So I think it's deeply undervalued. And I want to continue to be a buyer. And I do plan on adding in maybe another 1 or 2% of AUM. I think it's going to make possibly one more slight lower low here. And somewhere in around 37, in around that region, I'd like to add maybe another 1-2%, something like that, get the average cost lower. But over the next couple of years, which is the time horizon that I plan on holding this, I think this is a fabulous opportunity. And one thing that I don't hear is, so I don't know if you guys can see this, but if I zoom in, this here is the enterprise value of Baxter. So what happened here to drive the enterprise value higher? Well, they assumed Hillrom. So that was the acquisition of Hillrom. Company went from a $43.92 billion enterprise value to 58.91. When I built this chart, which is about a week or two ago, it was down around 36. As of right now, Baxter is probably around 37, 38. Let's have a quick look. So it's still 36. So we're getting, so if you look at pre-Hillrom acquisition, which is a profitable acquisition, yeah, very sloppy, absolutely. Did they overpay? It doesn't really matter. And it doesn't matter because we didn't pay for it. The average enterprise value we paid for the company was 40.88 billion. So prior to the Hillrom acquisition, the market was willing to pay 43.92 billion just for the existing company, excluding Hillrom. So we paid about a 7% discount, factoring in Hillrom as well. So if you look at the last year's growth in earnings, it wasn't as great as was displayed. But if you exclude out Hillrom, there's about a negative 3.18% hit to revenues year on year to the existing company. So the 18% growth on a constant currency basis that was disclosed factors in, it's assuming the growth of Hillrom, it's assuming the revenue of Hillrom. So when I'm looking at it, I don't think it's a very expensive business. I think sentiment's in the gutter, which I love to see. Valuation is deeply undervalued. Everyone doubts the company. And I can see a fantastic opportunity where, 1 to 3 year time horizon, it could be a very reasonable turnaround. So as of right now, we've built out a position in this. Our average cost is 48, not done. So I hope to get that down a little bit further. But I think it could be worth north of $100 per share. And that's what we're playing for here with Baxter. So that's very high up on the acquisition list. Another one that I'm looking to buy into is Alpha Metallurgic. We don't have a position in this as of right now. So Alpha Metallurgic is really interesting. I think I might have it here actually. Where is it? No, that was history. Sorry, it's not history that I need. It's bookmarks. There it is. Still demand forecasts. So what do Alpha Metallurgic do? Well, they mine metallurgical coal. Metallurgical coal is used in the production of steel. And so if you look at their customer base, the customer base that they have are decades old, and customers over 10% of the revenue comes from India, a little bit less than 10% China. If we get down to the bottom here and look at these markets for steel, not necessarily for coal, but in the production of steel, you're going to need metallurgical coal. The tonnage, the second largest, obviously, consumer is India, and it's expected to grow in 2023 by 6.7%. Pretty decent growth rate. That's the largest customer for Alpha Metallurgic. Company that paid down all its debt. It's a company that has over 400 million cash in the bank. It's a company that has an authorized buyback currently underway for 610 million left. This is a $2 billion business. It's about 22% of the shares outstanding that they'll be able to hoover up. And like, if you look at, let's say they hoovered up 20% of the outstanding shares, that's a 25% increase to earnings per share, even if net income didn't grow, just from those buybacks, because we, as owners of the company after the buyback, get more ownership in the business. And so buying back a ton of stock, it's lower risk. I don't know if it's going to be the best performing asset. It's lower risk because obviously they have no debt, but also it's somewhat vertically integrated. They own 65% of the export terminal. So they've got priority export capacity. It's capacity that does about 6,500 tons per hour, has storage of 1.7 million tons, pretty big terminal. They own 65% of that terminal. They've got very deep resources. I think it's something like 383 million metric tons in metallurgical coal. They also have some thermal coal. It's only about 15 million tons in reserves, but it's only 0.09% of their business. But anyway, this is a company where ESG factors are preventing funds from investing in the company. So you're not seeing capital flow into Alpha Metallurgic, which is allowing the company to buy back in droves their own stock. They only started doing share buybacks last May. They've already bought back 390 million worth of stock, and it hasn't been 1 year. And so they're able to buy back all their shares at very cheap valuations. If the market crashed tomorrow, but coal prices remain consistent and volumes were consistent, Alpha Metallurgic price is going to continue skyrocketing because the company are buying its shares for like 4 times earnings. And it continues to scoop up those shares at low valuations, again, because of ESG factors. A lot of funds are burdened by ESG factors. Some funds are not allowed to invest in, for argument's sake, coal industry or whatever it may be. And it creates a very unique dynamic for the coal industry in general, but Alpha Metallurgic. So when you're looking at the present value of cash flows for this specific company, coming out at around $383. Now, this is a company that has, 4.7 million in debt, 404 million in cash, and the equity price is about 2.7 billion. So this is a company that has tons of net cash. Newcastle coal prices are still up around 190. So the reason why this would be important to consider that $210, because if you look at pre-2019, average coal prices were about $80 per metric ton. So we're coming down, yes, but we're still around $210. The difference is the company has no debt. It's buying back tons of its stock, and it's got a low cost production, and it's vertically integrated. This could come back down to $100 per share, and it'd still be able to do buybacks in droves. So as of right now, are we going to see a low here or not? I don't know. On the week, is it open today? Market's open, so it's down 2% today. We're $209 per metric ton. I mean, this could drop another 50%, and the company is still incredibly profitable. When I look at AMR, what's interesting is when we have a look at AMR, which is the stock price, if I add in here market cap, just to have an idea of where we're at, market cap. So this here is pretty close to its all-time high. It's just off its all-time high, barely. Its market cap is down about 18%. It's down 27%. Why? Share buybacks, right? So they've bought back already about 13% of its float. So the market cap itself has gone down 27.7%, meaning that the multiple paid for the company is coming down, while off its peak, we're seeing a decline in the share price of 9%. So yeah, they bought back 13% of the stock over the past 7-8 months, and the share price is down 8-9%, while the market cap's down 27-28%. So you can see how once we start moving forward here, this could really break out. And from a technical perspective, again, I like to use Elliott Wave because it gives me an idea of the general path forward. From a technical perspective, this would be looking at some sort of wave 1, 2, 3, a triangle here for wave 4. You still need your 5th wave higher. So we're looking somewhere up around 380 on this, which is a pretty decent return. And again, it has everything that we're looking for. Has everything that we're looking for in the sense where, we don't need a resurrection of leverage within the market for that to work. We just need coal prices to be, above $100 per metric ton on average, which means that's, 55% decline from where we currently are. That's all we need. So there's huge margin of safety in that play for Alpha Metallurgic. So that's one. And then obviously Lumentum, which I spoke about before. Lumentum is one that we're waiting patiently for this to complete off its correction. I still think there's a little bit further on the downside, messing around with what the path forward could be. But I'm thinking somewhere between 54 and 55. I'd like to swing for the fences on this one. Cheap company. It's going to be systemically important. It's a small company, but they're a big supplier to Apple. 3D camera going into the AR, VR headset that they're working on. I think it's going to be a massive momentum in revenue for Lumentum. The interesting thing about Lumentum is the products that they sell are all in structural sort of bull markets, like long-term bull markets, whether it's LiDAR for self-driving cars. I think the only manufacturer of self-driving software that's not using LiDAR is FSD with Tesla. But outside of that, I think all of the other ones are using LiDAR. These guys are in that market. Security, they're all of their markets have huge trends. It's trading at something like 10 times earnings on a forward-looking basis. They got a one-time payment for a breakup of a merger with what was it? Cohort? No, can't remember. It was a semiconductor company that was to merge with them. Can't think of the name right now, but anyway, they broke up that agreement, and they ended up having to pay them out $217 million in cash for the breakup of that merger. That was paid in 2020, I think. So you'll see a big bump in revenue. So the decline in revenue has not got to do with poor performance. It's got everything to do with a breakup of a merger and a one-time payment for the breakup of that contract. But this is one somewhere around 54, 55. We'll be swinging pretty hard. Maybe tomorrow, if we open up in and around 57, I might start adding to it. But that's when we went over in the past, and that's really where we're at. We've got 19% in cash, and for me anyway, it's just a matter of, well, after last year, so much went wrong in such a short period of time. Like if you take April and May out of last year is perfectly fine. But the neutral rate going from 1.75% up to 4% really caught me off guard. So just got to act a little bit quicker. Jack in the box. One example of, we're getting back to fair value. Like the company, let's not be enamored by the company. Let's really focus on our job, which is to make money. And let's put it into something that has a better opportunity. If you listen to Peter Lynch, what made Peter Lynch so successful? Why did he get fantastic returns? Well, if you actually listen to him, it was rebalancing, right? So if company number 2 is up 50% and company number 7 is down 10%, but the fundamentals haven't changed, what do? Well, I'm paraphrasing what Peter Lynch says: sell 2, buy 7, and just keep putting the capital into better opportunities. So as well as that, there are a couple of plays like Crocs. Crocs is now we're really just relying on the outperformance of earnings. We're currently at about 12 times forward earnings. Latest earnings report, fantastic. It's a great, well-run business. Easy money's already been made though. But I'm looking somewhere up around 160 to 180, and I'll probably be entirely out of Crocs. But this is one where you kind of get to a point where the valuation of the company has already got, like, the easy money's been made, and we want to look for other opportunities. And I think that other opportunity is Baxter. Takes some time for it to bottom out. I think as of right now, it's easy to see the momentum and ride the momentum, but a lot of people might forget that, we wear down 50% in 4 months after buying this. It doesn't move in a straight line. A company can always get cheaper, and that's ultimately what happened here with Crocs. With some of the current portfolio positions, Overstock, I've never been in doubt. Like I'm almost certain, and certainty is not something that you want to use when investing, but I'm very confident that I make a lot of money in overstock. And the reason being is when people look at overstock, they mischaracterize it. I'll show you what I mean by that. Like if we pop on over here, there was one comment. I'm not picking on anyone or anything, but overstock's not a cryptocurrency play at all. Overstock is like, there is cryptocurrency which is used to transfer wealth or some sort of value, and then there's blockchain, and blockchain is completely, they're not the same. And I think what happened over the past couple of years is we have a blockchain, people attach some garbage token, and the arbitrage is they're not creating any value. Their only arbitrage is their marketing skills. So we attach a JPEG or whatever to a non-fungible token. We sell some sort of tokens on that. Like that's essentially what it came to. But there are some real life applications for blockchain. And we've got like the cream of the crop we own with overstock. And I'll explain GrainChain now in just a moment. GrainChain just raised 29 million. Most people that own overstock have never heard of GrainChain, but they're an owner of GrainChain. And that's the thing that's really kind of frustrating about overstock is I have very little faith that anybody, including professional investors, will actually do the work and understand what they own. To a lot of people, it's looking at price to earnings and then deciding whether they want to buy it or not. And that's it. It's peeling the first layer of the onion, whereas overstock, in my view, is a massive gold mine beneath the surface, but it comes down to when is that fairly reflected. And I'll talk about certain paths forward in just a moment. So what is blockchain and what are the assets? So like a very high level view of blockchain, for those of you that don't know, this is blockchain, right? Blockchain is like, it's like a spreadsheet, right? And it's really good for accounting, not just financial accounting, but supply chains. It's also very good. Like if you look at the portfolio of assets that we have within Medici Ventures, the companies that are in there, for argument's sake, votes, right? So you have a specific, like we can have column, we can have literally cell A7. Now that can't, there's no double entry there. It can't be recreated. And that double entry might be given to a specific individual like you or I. And we use that to vote. So there's no double entry. Decentralized voting, votes, that's essentially what it does. And so it's a way in which we can be more efficient, more accountable, with more transparency to do specific jobs. So you look at something like GrainChain. GrainChain is really interesting. They solve supply chain issues in the agricultural space. What is the company? Why are they raising 29 million? Because it's a fintech company, but it's based on the blockchain. Don't mix up blockchain with crypto. They're very different. GrainChain, just read this paragraph for you guys. GrainChain integrated fintech tools into its smart contract solutions to enable new liquidity options to farmers and offer prompt payments upon delivery of commodities. This includes the ability to create lean instruments, deploy and manage capital and insurance products, monitor and track farming operations, and facilitate repayments of funds. That's not a crypto, like it's using smart contracts, blockchain in order to facilitate some sort of transparency. So blockchain has real world applications and we have the cream of the crop assets. Before this deal, we own 17.4% of GrainChain. When I first invested in overstock, I wrote this off as a zero. They just raised, this is 7 days ago, 28th of February. No, this is today, 7 hours ago, but it was last week. These guys just raised $29 million. And Pelion Ventures, who's the general partner overseeing Medici Ventures, their lead fund invested 10 million. They became the lead investor. They led the round. 29 million on what valuation, I don't know. But it's a company that I own in overstock that nobody else knows even exists. Let's say we own 10%. They take the 29 million, they turn it into a $500 million business, billion-dollar business, maybe. Last year it was voted, so there it is there. It's Pelion tapped its flagship fund series to make a 10 million investment. So these guys obviously a lot of promise. Let's say we own 10% of this. Let's say the funds get them up to a $500 or $1 billion valuation. Let's say it IPOs, or let's say it's sold at that some point in the future, because there's a huge amount of momentum behind this business. So what? Like, how do we make money? Well, if you actually go and look at the terms of the agreement between Overstock, Pelion, and Medici, the cash that's generated gets distributed, the percentage gets distributed back to Overstock, 99% of it. So we would end up with close to, let's say, 50 million at a 500 valuation if there was a liquidity event. Where does that go? It goes straight into our cash balance at overstock. Where did it come from? Nobody has any idea because nobody does the fundamental analysis of what's in that portfolio. So you have Grain Chain, which is solving for all these issues. You have other companies like Votes. So the voting industry in the US is currently a monopoly, but there's lots of problems with it. There's problems down in Brazil. There's problems everywhere. A lot of sort of mail-in ballots. There's huge problems with mail-in ballots. Whether there's some sort of fraud going on or not, the system's not watertight where people can make those claims. I don't know. Not smart enough to know. Using blockchain, Votes have come up with a way to create decentralized way in which we can vote. And they have a real possibility of winning government contracts around the world. Again, nobody knows we own this. Medici Land Ventures, what's a big problem with buying and selling a house? The titles of the deeds to the house, the title, the ownership of the house. Same with vehicles, but in this case, Medici Land Ventures, another portfolio company that's solving a real problem, and it's transferring. So yeah, Raz, they own 17.4%, but they've just done a $29 million round. So I don't know what they own right now. So I'm assuming, let's say it was 10% because we did get diluted. So you're right, it was less than 20%, but my point was 29 million. Let's say it scales up the business with all the momentum that they have. Let's say we get to a 500 million valuation. I don't know what the valuation was. I don't think it was disclosed. But let's say we got diluted quite significantly, but the cash that was brought in enables all these fintech tools, and at a higher multiple for a company in the fintech space, company grows to a 500 million valuation. We own 10% of it. If there's a liquidity event, I'm assuming 10%. It's definitely less than the 17.4%. It's 50 million. Overstock's not a big business. It's 5% of its equity valuation, probably more. Like, what's the equity on Overstock today? Yeah, it's about 5% just in that, but people don't even know it exists. That's the point that I'm trying to make. So we constantly talk about stuff like, well, we constantly talk about T0, but there's so many other prospects in there that continue to grow. Like, people write these companies off. Like, this is not a small business. 29 million is, in this market environment where venture just got destroyed, private equity got destroyed, T0 raises a bunch of money, Grain Chain's raising a bunch of money. These are solid businesses. At its lowest valuations, these guys are still able to raise significant capital. That portfolio, I only had T0 really being worth anything in that portfolio. And I think it's worth a lot of money. But now I'm starting to realize that Grain Chain, okay, we own a small percentage of it, small piece of the pie, but it could be a very big pie. And it's not accounted for. I haven't got a clue, Raz. And I don't think that's been disclosed anywhere. They'll probably have to pay some sort of capital gains tax. I'm not sure if they could write it off against investments. I'm not sure how you'd account for it, to be honest. There's a lot of internal stuff that I don't have access to. So Raz is just asking what would be the tax on that if there was an event. There may be no tax. There may be absolutely no tax. In that, if it was an IPO, we would just get distributed shares. Very efficient way of spinning it off. There's a lot of mergers and acquisitions that it could merge with ICE markets as an example. And it could merge in a reverse Morris trust as an example for tax efficiency purposes. When we just get shares, maybe we get spun off shares, there's some sort of dilution in ICE markets. It doesn't necessarily have to be a tax event. There's many different ways to structure it, but we're not there at the moment. I don't know. I don't know what you could write off against it either, but it's not something I'm too concerned about right now. Those businesses, I think, are multi-billion-dollar businesses. But I just wanted to point out that the fundamentals continue to get better for that entire portfolio. And you have like stuff like Bit Global is another one there that Raz is talking about there. Bit Global is a platform for CBDCs, and how they generate money is they partner with the local central bank in whatever country, and they get a commission. It's kind of like a Visa or a MasterCard for CBDCs. And so they've got, I think, something like 7 major central banks partnered up. This company is priced at zero. That whole portfolio is priced at zero, but they're real assets generating real revenue. Some of them, yeah, the revenue might be very small, but the prospects are huge. Prospects are huge. And they continue to raise significant amounts of money in a very difficult market environment, which tells you that the fundamentals, despite these being private businesses and we don't get a lot of information on them, tells you that the fundamentals are very solid. I can tell you venture capital are not just crossing all their T's and dotting their I's anymore. They're going over each deal the second, third, and fourth time after FTX. The who's who of venture capital invested in FTX and done zero due diligence. those days are gone. And the fact that these guys were able to raise 29 million, and the lead on it was the investment, it was the general partner of Medici Ventures, Pelion. It says an awful lot about the fundamentals of the business. Again, when I invested in Overstock, I thought this was a zero. I didn't think it was worth anything. Now you have Minds, which is decentralized social media. You have Votes, which is decentralized voting. Medici Land Ventures, using blockchain, transfer titles, stuff like that for property and deeds. You have Grain Chain, which is providing all of these different tools for the agricultural industry. And then you have Bit Global, the two big ones, Bit Global and T0. It's really exciting. It's really exciting. So the question is, how does all of this value that's being created in Medici transfer over to Overstock? It's kind of interesting because there's a number of different ways it could occur. Obviously, according to the terms from Medici Ventures and Pelion Ventures that was signed with Overstock, once a sale was made, if it was a cash sale, it'd be distributed back to Overstock. But it doesn't always have to be a cash sale. That's one way. It could be an IPO, like in the case of T0, 3 to 5 years, like that platform's now set to go. It's fully regulated, right high-grade human capital, right partnerships, plenty of cash. They're out of the crypto business, and that's why I brought it up a moment ago. They're out of the crypto business, but that was never really their plan. Their plan was more so, it's more so looking at, like, it's more of a blue ocean strategy. If you haven't read the book, Blue Ocean Strategy, I would definitely recommend it. But what they're doing is they're providing liquidity to private markets. So you got like venture capital, where you might have to go into a closed-end fund and you may see your money locked up for a number of years. So venture capital, you might have to invest for a specific period of time. There's no liquidity to get out. And there might be times where the fund is worth more or less. Putting an arbitrary date on it may not be maximizing your return. So venture capital, private equity, real estate, syndications, all of these different markets are private markets, and there's not a lot of liquidity. So what are T0 doing? They're providing secondary markets for these. Like, I don't think there's anyone at scale doing it right now. I think there's a couple of small platforms trying to innovate, but no one has the high-grade human capital and the partnerships like T0 with ICE Markets. And they're the first to have a wrapper that's SEC approved. So they got out of the crypto business, and they got out of the crypto business maybe a week before the US started to stamp their foot. And again, that could be their connections. Through the grapevine, they could have heard that this was coming down. So they just decided, listen, we're going to front run it and get out. So that's sort of like the blue ocean strategy, where they're going after markets where they could probably charge much higher margins, trillion-dollar asset classes, huge asset classes with no participants. That's what T0 are going after. So much higher margins. Problem with the crypto business is it's a commoditized business. So trading and exchanging digital assets, whatever it may be, like Bitcoin or whatever, what's the like, I don't trade it very often, but when I bought Bitcoin on Coinbase, they charged 1.5%, and I was happy to pay it because I knew that they had security protocols in play. Today, I think, there's a lot of platforms charging 15 basis points, 25 basis points. So the commissions on it are a lot lower. Huge, no barriers to entry, huge competition. It's commoditized business. What's really your edge? Before, with Coinbase, they had an edge in that they were a lot safer than some other random exchange. And to be fair, they haven't been hacked in their history. So that edge is really going. It's really starting to disappear. And so the going into the crypto market is going to drain the resources, not going to make a huge amount of profit, and it's highly competitive. Shut it down, refocusing their attention on, I'd arguably say, bigger markets, because there's less competition. So there's more, it's a smaller pond with much bigger fish in it. Let's put it that way. And so that's essentially what they're after at the moment. But look, I think that, going back to what Drell Greenblatt says, if you get the valuation right, it's just a matter of time before the market agrees with you. So how we could essentially distribute cash back is cash sales. And again, then Raz's point here is there will be a tax event, and how's that going to impact the returns? To me, at these prices, it doesn't matter, because that whole portfolio is free. So if there's a tax event, it means we made a profit. But it can come in the form of through mergers and acquisitions. It could come through the form of IPO. it could come through the form of cash sales. There's many different ways in which that value could be transferred. And it could be the case, let's say in like 5 years, T0 is spun off and we get shares of T0 as a publicly listed company. Well, we've generated value in that because we get that ownership and the market will set the price of it. Overstock share price may not go anywhere, but because we owned it, we were entitled to a share of T0 on its IPO, if that makes sense. So that creates a liquidity event for us as investors in Overstock. But the share price may not move, but we'll get our shares. And that's sort of how those bigger ones like Big Global might be acquired. I don't think it'll go public, but something like T0, if it went public, that's probably what it's going to look like. And so that's essentially what we're waiting for, is that portfolio to unlock its value. And it's great to see consistent, good news coming from that portfolio. I now have about 7 companies out of 20 that look incredibly interesting. Grain Chain is really exciting for sure. It's one that's really exciting. It's in the fintech space as well, so it's going to get a much higher multiple. So that's always interesting as well. Okay, if anyone has any questions, fire away. I'm going to go through some of these. What do I think about Warner Bros. Debt levels? Also, why am I not increasing position in Micron? So first on Warner Bros. Debt levels, they're not a problem. And they're not a problem because the average maturity is 14.4 years. Sorry, it's 14 years, not 14.4. And the interest expense on average has actually come down. It's come down recently because they paid down some of their higher interest debt, but the average interest expense on Warner Bros. Is now down at 4.13, is it? 4.07. So 4.07% is the average interest expense on that debt, and it doesn't mature for 14 years. So long duration on the debt, fixed rate interest. So interest rates moving doesn't matter. So when we look at their unlevered cash flows based on forecasts, pretty decent cash flows. So quite content with that. So I'm not concerned about the debt levels of Warner Bros. And why am I increasing my position in Micron? So Micron's interesting. That whole space, like what happened to Micron, they got caught off guard, but it wasn't just them. I mean, you look at companies like Samsung as well. You look at companies like Digital Turbine, they all got hit by the same thing. The mobile phone, not replacement, but upgrade cycle collapsed last year. It was down 12% ex Apple iPhone. And so obviously chips got hit for Digital Turbine. Sales on new devices by having apps already pre-downloaded slowed down, hit the market pretty hard. It came down sharp. And what's interesting is the commentary from all of these companies. They're in different industries, different sectors. They're not connected at all. And they all have the same commentary that mid-2023, we'll likely see a bottoming and we'll start to see an improvement into the end of the year. I haven't added to Micron because if you look at the significant impact that those downgrades had on its income, like we can have a look at it right now, you will see like this, the estimates came down massively to point where EBIT, for 2023, EBIT's down negative 1.9 billion. Now, fair value, even factoring in that going from positive to negative, is still coming in at somewhere around $80, $84. So I'm still holding the position. I still think it's undervalued. But my expectations were it was worth 150, 160, slow down a mobile cycle at such a rapid pace, massive downgrades, negative EBIT this year, impacts their business. It should recover next year, but I want to see a little bit of movement first before I increase that position. But it's a possibility for sure. Yeah, it's a possibility. But I'm not in a rush just yet. Does the shutdown of T0's crypto affect my outlook? It doesn't at all, for the reasons I mentioned a moment ago. Very welcome for the video. Plenty of exposure to crypto. So my question is, do I think this is good to have? So Anders, in the most polite way, and I don't want to pick on anyone or anything like that, but you can copy someone's idea, but you can't copy their convictions. And, you start I'm in a very unique position where I've got a little bit more perspective on this. Start off on YouTube, talk about ideas, invest, diversify, manage risks best of my ability, have conviction, like for argument's sake with Overstock. Overstock I thought was going to play out in a very short period of time. There was a lot of momentum, a lot of positive sentiment. I can see the value. I didn't realize that the market wouldn't see the value. Even to this day, like we talk about stuff like Grain Chain. People don't know that they own Grain Chain if they own Overstock, haven't got a clue. And so there's a lot in that business that you got to peel 1, 2, 3, 4, 5 layers below into the onion before you actually realize its true value, that a lot of people don't realize. I do, so I've got conviction. And so you can copy someone's ideas, but you can't copy their convictions. And so if you're going to invest in Overstock, you have to invest in Overstock with your own fundamental reasoning as to why it's a good investment. And you got to take that responsibility for your entire portfolio. Each individual company, you got to look at it, you got to analyze it, come up with a conclusion with what it's worth, expectations. You got to have high conviction because markets are not linear, and you got to manage the risk when things don't go right. Because the thing about investing is there's a high fail rate. There's a very high fail rate. And by high fail rate, even somebody that gets 80% of their investments right, 20% is still a high fail rate, right? And so most people not getting very, very, very high success rates with their trades. So you really got to have that conviction, diversify, understand it, and then you'll know where you're going right or where you're going wrong. The alternative to that is just buying the index. So I did read these here, but I'm not going to go into any analysis of any kind, because I think people, like, the one thing I've realized is you really have to know what you own. And I don't think it's very productive. Like I'm as enthusiastic about Overstock as an example as I've ever been, probably more so because I'm starting to realize, well, wait a second, Grain Chain, I thought was a zero. Jesus, this may not be a zero. Okay, we have small ownership, but I think it could be worth a hell of a lot more than zero. And therefore I got to really reconsider what my expectations are there. So I'm as bullish as ever, and I may increase the position again when I start to see positive momentum, but other people don't look at it that way. It doesn't work. It doesn't work out right away, and therefore it's never going to work out. And look, there's a lot of companies, such as, like, even look at Warner Bros. Discovery. My conviction never changed in Warner Bros. Discovery. Did I know it would rally from like $8 up to 15? I got the average cost down to, I don't know what it is, but it's a lot lower than what I originally paid. I just kept buying it the whole way down. No, but I have conviction. I have very high conviction in the company, and therefore I don't want to sell it. I want to buy more. And that's sort of my frame of mind. And eventually, going back to what Joel Greenblatt said, if you get the valuation right, it's just a matter of time and letting the market play out. Alex is asking, am I aware of issues with some copiers? I'm missing 3 positions, apparently due to the less than $1 rule, even though my portfolio value is nowhere near the minimum. Do I have any info? I'm not familiar, Alex. I heard from one person, and I did reach out to my account manager, and my account manager said she checked that the copy sync was one of the highest, over 99%. And I'm not getting any new copiers really. So there could be a couple, but I haven't heard from anybody. They'll copy $1 is the lowest amount. Sometimes I add 0.5% of AUM to a position. So my understanding would be minimum copy, probably somewhere in the ballpark of 400. You should be fine. I'm not sure why you're out of sync, to be honest. No, because it's not like there's a lot of movement in the portfolio at all. Like 4.86 trades per week, and the reason why it's 4.86 is because I don't just buy, like if I buy Jack in the Box, it's not one trade, it's like 3. Meta, I reduced the exposure. Meta, I still have an open position, but there's 5 there just from that reduction in Meta, 3 from Charter. So I don't know. Reach out to the customer service and ask them. They told you it was the $1 rule, so that doesn't make a lot of sense to me. If you can send me a message on eToro and let me have a look at your portfolio if it's open, and I can go through each one. We'll have a look at it from there. Okay, Ronnie, thoughts on new purchase of rigs, and I guess you mean Transocean. So Transocean's another one actually. Transocean, it's always presumed to be a bad company if it doesn't go up in a linear fashion. If you get the valuation right, eventually the market will agree with you. So I think you're talking about Transocean. So I'll go through this now. So Transocean is a company. In my personal account, I invested back in March. I invested in Southwestern Energy on eToro. You guys might remember that. We did have it in the portfolio back in 2020, 2021. And I invested in Energy Transfer. And I also invested in Transocean, but not on eToro because the buy button was frozen, became a small cap, very illiquid, and they weren't offering the opportunity to invest in it. So I actually bought into this over here. And this is a story of my life. You find a company that's deeply undervalued, and you have to understand that if you're planning on outperforming, like if you want to double your money on a company, if you want to triple your money over a couple of years, the market has to be dead wrong. Has to be dead wrong. Now, this is a company that had liquidity for 12 to 18 months. Sorry, 12 to 24 months, I would argue. Can't remember. It was 3 years ago now. But it had money for about 12 to 24 months, something in that ballpark. I think it was closer to 24 months, actually. They were losing money hand over fist, but they were fine for about 12 to 24 months. If the industry didn't turn around after 2 years, it was a bankrupt business. I knew that getting involved in it. But I also knew that when oil prices go negative, capital expenditure collapses. And as capital expenditure collapses, supply comes down and the price of oil starts to recover. And the whole curve bounces higher. And it becomes more sort of economic to actually drill for oil. And that's exactly what happened. So it's not a guarantee that it's going to play out that way. But in this case, it did play out that way, where there was enough time. The company, the residual value of just its assets, which are all like pretty much tangible assets, is $15 per share. And so it's $15 per share. The market cap at the time was 650 million. Obviously, they issued some equity since to get by and refinance and bring down their debt levels and make the business more manageable, because they had 2 ships coming online, which have now been sort of acquired, and they're doing perfectly fine. But this is a company that did have some challenges. It originally doubled. It was down 50% at one time, and then it recovered. And then it didn't do anything for 2 years, despite the fundamentals continuing to get better. And then, just as the market would have it, in the last 1 year, it's in even less, in the last 6 months, it's up 110% in 6 months. Market sort of re-rates whenever it wants to. Where we are as of right now, if we're looking at cash flows, and I could argue that we're going to continue to see more and more upgrades. You've got a utilization rate of offshore rigs at 88%, 89%. And you're seeing demand increase by 15% year on year. So what that's doing is putting upward price pressure on the day rates for these rigs. If we look at the present value of its cash flows, and I'd argue that this is going to continue to upgrade because I think we're going to continue to see higher day rates, we're in at about $7.80. So the question is, Rob, we've done very well. I don't know, in the portfolio, I think we've doubled our money. Why don't we take some profit here? The reason why I don't want to take profit here is because I think this can double again from here. I don't think it's as easy now. The easy money, I think, has been made. But the reason why I think it can double is something interesting happened in this industry, where all of the shipbuilders got burnt in the last cycle, and they were left with not just the burden of the debt for building these ships, but they were also left with half-finished ships. A lot of them went out of business, and because the industry went downhill for a decade, nobody studied to build offshore rigs. So now what you have in the new cycle is, because shipbuilders got burnt, they want 40% down, and it'll take about 7-8 years to build. So if you look at Transocean, they committed to buy 2 drill ships, like, 2014, I think it was. They agreed to pay 650 million. They ended up paying 1.2 billion for those 2 ships. Costs spiraled out of control. But not only is that a problem, but putting 40% down means that the return on that investment 7-8 years into the future just doesn't make sense. And the uncertainty with the current rhetoric from governments, mainly the US, Biden's administration, are not very content with oil production. So onshore is not a growth market, but offshore is. You have a situation where no one's going to build new ships. So if you look at, obviously, freight, There's a lot of new ships coming online, but that's not happening for offshore rigs. So you have a high utilization rate, unlikely to see supply come online, meaning that the rigs that are currently built are worth their weight in gold, or at the very least, they should be worth the residual value. And that's $15. So when I look at Transocean, I think there's going to be tailwinds to earnings with higher day rates. I think that we're probably likely to get closer towards this tangible book value of about $15.45 per share. And interestingly enough, when I look at the chart structure, that could be your A or 1, 2 or B, and then 1, 2. We're still in the wave 3, 4, and 5, which get us up to about $18. So I'm not adding to the position here. I'm not adding to it here, but I still think there's a lot more upside. I just think the easy money's been made. With CleanSpark, earnings for CleanSpark done very well on their earnings. I did post a comment here, and I think I went over it before. So that vote's actually coming up in a couple of weeks. But CleanSpark, the only thing that concerns me is like the operations from an operating perspective. They're not doing anything wrong, but I think they're setting themselves up for the incentive cost biases to be very negative. When you put in a clause to increase compensation to 15% of outstanding shares, while you're asking for approval to increase the number of outstanding shares by 300 million, the incentive cost bias of that is to issue shares to get higher outstanding, or to get higher compensation, because that's going to be automatically adjusted. And so then calls into the question, okay, if you're very greedy, which it's in human nature, as much as I think management perform very well, the incentive cost bias here could be pretty damaging. But anyway, what's the return on that investment? If they issue 300 million shares to buy different companies or whatever, is it going to be for the increase in stock-based compensation, or is it going to be based on return on invested capital? And I don't know the answer to that. In these examples, there are some examples. Aurora, ACB is an example. Aurora Cannabis went on an M&A binge after it IPO'd. Low float, M&A binge, share price goes up 60x. In a bull market, everything goes up. And then as you go into a bear market, not only are they down, but they're down 82%. And they're divesting an awful lot of those M&A deals. So it's not the concern on the upside. It's the concern when the bull market ends. What's the fair value of the company? If there's a lot of poor M&A deals, could be a zero. So right now, I'm just content with what we have in CleanSpark. I think we're only starting the move, to be honest. I think we're only starting. I've seen Bitcoin up. I see Bitcoin up today. Up 2%, yeah. Anyway, with those deals, it's something to keep an eye on. So I don't plan on increasing it. And I think we have like close to 4% invested in CleanSpark. We got 3.91%. I'm happy with that. I don't need to increase that. Out of all positions, GoPro, I'm not very confident in. Okay, let's have a look. So also this question here I missed. Why am I not invested in Tesla or Google? I think in the case with Tesla anyway, I think it's really a question, certainly at these prices, what the market's going to pay for the multiple. And when you have a promoter like Elon Musk, I mean, the market could pay a lot, but I think you're literally, it's a binary outcome. What's the multiple going to be? Flip a coin. I don't know. And so for that reason, I just don't think there's enough meat on the bone. Google, interesting, but I don't know what's going to happen with stuff like Bing. Bing is getting a lot of negative press, but the question is that guerrilla marketing, right? So P.T. Barnum, if you guys have ever heard of P.T. Barnum said, bad news is good news because it gets more exposure. And that came when he bought a circus and there was a lot of negative reviews and he sold out a circus despite the negative reviews. So when you're looking at Bing, ChatGPT, I don't know what's going on there, or OpenAI and Bing, I don't know what's going on there, but there is a lot of talk about it, let's put it that way, across social media. Guerrilla marketing, I don't know. It would be genius if it was. If that is the case, does Google lose market share? I certainly haven't been using Bing, so I don't know what anyone else is doing, but I haven't been anyway. So for both reasons, I could look at Google and I could say, look, it looks cheap. But if we start to see a reversal in it, I think they have 72% of search. If we see that go to just 71, 70, how does the market read that? How does it price the asset? I don't know. I don't have the answer. But Google's a solid business. It's not going anywhere anytime soon. But as you guys seen, the market hit it pretty hard over 2 days when that partnership with Bing and OpenAI was announced. So I don't know. I just don't have an edge there. So I'd rather avoid it. Would I mind going through some of the latest actions? Brief explanation. Yeah, that's what I wanted to start off with. So I hope that was clear. What are my expectations for Warner Bros. Earnings? To be honest, I have no expectations, and I don't think it really should be quarter to quarter. What I want to see them continue to do is debt reduction. They have been paying down $2 billion per quarter. I'd like to see like an improvement in terms of subscriber growth for HBO. And yeah, I'd like to, here's the thing with Warner Bros. If we have a look at Warner Bros. Income statement for last year, if you're not very up to date with accounting, the first thing you look at is net income. You're like -5 billion. These guys are losing money hand over fist, which is not correct. So, and the reason why I say that is, have a look here. We've got depreciation and amortization at 5 billion, and there was also merger and restructuring charges, which are non-cash expenses. So what are those? So you've got depreciation of content, and some of the merger and restructuring charges was getting rid of specific assets. So those one-time expenses show up here as a net income of -5 billion, wherever it is, -5 billion trailing 12 months. And that looks terrible. It looks absolutely terrible. But these get added back. So if you look at amortization and deferred charges of $10.8 billion. So where did that come from? If you guys remember, was it Batgirl or Supergirl or something like that? Was it Batgirl was canceled? So yeah, Batgirl. So there was a lot of controversy. That's why I bring this one up. So Batgirl, Discovery canceled Batgirl from production. And the reason being is a couple of reasons. The reason being is Batgirl was a high production. It was a really high production set that created this movie. It cost a lot of money. And in order to generate a return on that investment, you would have to increase a massive marketing budget. The management came to the realization that this is not necessarily for a broad audience. It's more for a niche audience. And they didn't think that if they ramped up marketing spend on this to get a return on it, they didn't think they'd make a decent return. So what they decided to do was the money that was spent last year and the year before by HBO before Discovery owned it, like that money's already spent. That cash flow is already accounted for years ago. That money, they're going to write it off as an expense, as an example, for tax purposes. So they'll be able to offset taxes over the next couple of years, I think, by tons of write-downs, including Batgirl. Now, I think that I don't think they can't make money, they can't sell it anyway. But I wonder, could they include it in their subscription? Does that count? I'm not sure. But they can't do a premiere. They can't, if they write it down, they can't sell it. I don't know if it's included. It might be included in, well, if you're selling ads, is that selling it? I don't know. I don't know if they'll be able to use it again. It could be gone forever. But that's essentially all those asset write-downs. So when you actually look at the cash flow last year, so cash flow after debt reduction of $7 billion, there was $1.6 billion left over. So they paid down $7 billion worth of debt. $7 billion worth of debt. Actually, no. There was about $6.5 billion worth of debt. Still had 1.6 left over in free cash flow. Sorry, not free cash flow. Sorry, free cash flow is cash from operations minus. So that's not correct. Excuse me. That's not correct at all. Free cash flow is cash from operations minus capital expenditures, and there was 1.6 billion left over. So yeah, okay, their cash balance increased because they would have assumed some of the cash. I think it was 2.5 billion from HBO, but a lot of those write-downs. Okay, changes in net working capital as well, increased 9 billion. But anyway, they were able to pay down a huge amount of debt. They were free cash flow positive, and a lot of people are focused on the net income saying it's a terrible business. It's not the case, because a lot of that money that they were writing down as expenses were from years ago. It wasn't from last year. So the company was still solid. The reason why I bring that up is because last year you had the reverse Morris trust. And the problem with that was, if you have a look at volume, like after the acquisition, look what happened. Volume increased massively. In a falling share price environment, if you bought AT&T and a company spin off in a reverse Morris trust and you received shares of that company as a dividend in a falling share price environment, what are you likely to do? Probably going to sell it. And so what happened? Huge amount of sales from Warner Bros. Discovery right after that acquisition. Now it's come down a lot, but at the time it increased massively. And I could speculate and say that an awful lot of AT&T shareholders probably sold out in a falling share price environment to buy more AT&T shares. So I'd say that probably happened. On top of that, there was a lot of negative news over the net income being negative. But again, when you peel a couple of layers, you realize that their strategy was to build up tax write-downs, and all that's in the rearview mirror. So I'd like them to continue to pay down their debt, which is part of the fundamental thesis. I'd like to see improvements on fundamentals. That has been a little bit rocky, but that's sort of what I'm looking for. Debt reduction, a little bit better than expected on HBO or whatever. That being said, we ran a lot, like year to date. I think we're up like 60% year to date. From a technical perspective, I can see this dropping down to probably as low as $11-12, at which point probably add some more. But I could see this correcting lower before we continue pushing higher, but it's an opportunity to buy some more in my view. So we'll see what happens on earnings. I don't know, but a lot of the negativity is in the rearview mirror, asset write-downs, and as well as that, the effect from the merger. Spoke about Meta. What are my thoughts about lawsuits against 3M? Okay, so this comes up quite a lot. So those lawsuits on the earplugs are from 2018. It's not a new lawsuit. It's heading for 5 years old. So let's just like get a little bit of perspective. There's people out there saying this is going to be $100 billion they're going to lose $100 billion, $200 billion. Like, some of the numbers out there are bizarre and they're very high. If we have a look at 3M and we have a look at its enterprise value, so if we look at the valuation of the business, its liquidity, and then if we look at some of the claims that we've seen in the past, what are the largest class action lawsuits, we'll get a little bit more perspective. So off its high in 2018, when this lawsuit came about, it was $154 billion enterprise value. Today it's 79. It's about $75 billion less, the enterprise value from 2018. So the market has repriced the asset down $75 billion. So the company today is very different to the company over here because there's no uncertainty regarding the lawsuit, and there is already some sort of discount in terms of the valuation, which would factor in an awful lot of risk. That's the first thing. We have seen a lot of moderation in terms of its valuation. So the second thing is, let's have a look at its balance sheet. So there is ways in which they can tap into more liquidity. So if we go to the balance sheet, we've got just short of 3.9 billion in cash. Is that all the cash we have? It's not really. So that's an asset. Cash is an asset, right? But we also have equity, right? So if we look at shareholder equity, and shareholder equity might be, let's say they have a private jet, that would be considered shareholder equity. We can liquidate that. It's not fundamental. Let's say we have a lot of buildings. We can strip those assets out and lease them back, and we can raise cash. So if we have a look at retained earnings has gone from 2018, it's gone from 40 billion up to 48 billion. Retained earnings have increased 8 billion. We can liquidate some of that, whatever it may be. Again, asset stripping is a possibility. It's less favorable because you probably bring down your net income. But if the deal was bizarre, is there assets there to pay it down? Yeah, there's about 48 billion in shareholder equity. And then you probably want to leave your 3.9 billion there. You could probably cut that in half anyway. But there's about 3.9 billion there for operating cash flow or whatever it is necessary for the business. But there's 48 billion in shareholder equity that could be liquidated in order to offset a class action lawsuit. And remember, this is a company where the valuation has dropped 75 billion. It's trading at about 10 times enterprise value to its earnings. So when we have a look at largest class action lawsuits in history, this is as of August 2022. This is really important for context. So we'll make it on a bigger screen. Maybe I need to go out one more. There we go. So the largest one in history was tobacco, and that was back in the late 90s. This was in, it was in the late I think it was in 1998. There it is there. But this was for an entire industry. Well, 4 companies. There's not like Philip Morris have about 10 or 15 of the top brands. R.J. Reynolds. All tobacco's quite a narrow market, so not a lot of competition there. 206 billion paid over 25 years between 4 companies. So when you're looking at 206 billion, you're like, wow, that's massive. So 206 billion, if it was equal, it's probably not equal. Probably Philip Morris had to pay a little bit more, bigger company. But 206 billion divided by 25 years, divided by 4, it's 2 billion per company per year. And remember, time value of money. Over time, you have pricing power on your revenue, so your earnings go up. So today, 2 billion is not going to be worth the same as what it would be in 25 years, if that makes sense. Time value of money, inflation, as an example. So that was the largest class action lawsuit in history. And they were given 25 years to pay it between 4 companies. Time value of money, the 2 billion after 25 years is not worth anything close to 2 billion relative to when it first came out. Time value of money. Second largest one was BP, Gulf of Mexico. Remember the leak? That was 20 billion. I wonder, does it say how many years? 20 billion was the second largest. BP claimed 15 billion of the settlement as a tax write-off. Okay, so there's some benefit, I guess. The tax write-off, you can pay your 20 billion. So it's 5 to 6 billion, provides payments to state and local government. I don't know how many years that was over. Claimed environmental damage. I don't know whether they have to pay it up front. But the second largest was BP, 20 billion. Then Volkswagen, Enron, and then you get into the single digits. The reason why I wanted to bring this up is to give it a little bit of context. I'm seeing numbers like 100 billion, 200 billion thrown out there like class action lawsuits. Is that fair? Is it possible? Yeah, anything's possible. But is it fair to assume those numbers? Well, I think the odds of that occurring are quite low, simply because the last time we had anything even close to that, it was an industry, and it was in 1998. And since 1998, over the past 25 years, we haven't had a single class action lawsuit against an entire industry, but we haven't seen anything in excess of 100 billion. So I think a lot of the headlines on social media, etc., is a lot of fear. I do think it's going to be there is going to be a settlement, because I think some of the class action lawsuits that were taken against them have won. So I think there will be a settlement, and I think that those settlements might be amortized over a number of years. And as you seen a moment ago, it could be used as tax write-downs. But the company has plenty of equity in order to finance it if they had to pay it up front. So I'm not in the camp that it's 100 billion. I think the valuation is very attractive right now. This is something that's gone on for the last 5 years. I actually think if there was a settlement, and even if it was like 50 billion, but over like 25 years, I think the share price would push higher, because there's certainty. Markets like certainty. It's something that the company could manage. There's plenty of equity there. So that's sort of the way in which I'm looking at 3M. I'm well aware that that's a problem, but I also think that the risk to reward is very attractive in and around here. We can look at it from a number of different ways. From a chart perspective, as you can see, I'm looking at this as what's known as a W, X, and Y. I did think that the correction might have completed here, but it went lower, and I think I added some more recently. Our average price is like 118 anyway. We just scaled in. I think it's a good opportunity in my view. And I think there's a lot of known negatives. The enterprise value is down 75 billion. Company's still very profitable, high returns on invested capital, reasonably good liquidity for operations. And then there's a lot of shareholder equity that, if push came to shove, or whatever might have occurred, it could be an asset strip, it could be sell off of non-core assets in order to finance it, or it might just amortize over a number of years, and you can use it as an asset write-down, like what we've seen with BP. So there is possibly a lot of positives to that as well. What are my thoughts about earnings of GoPro and Dropbox? So I can't give any comment on Dropbox. I closed that out last year, and I haven't really been following it. So I don't exactly know what's going on there anymore. With GoPro, look, GoPro is really easy to understand. It's not a difficult business. So let's just pull up GoPro and let me just type a couple of things out. So GoPro used to be primarily hardware. So it used to be like pretty much just hardware. And the problem with that is you sell a camera, it's a durable good, it lasts for 3 years before it breaks down. And then you buy another camera 3 years in the future. So you get one net income and you're not even guaranteed recurring revenue at some point in the future. So you have this sort of dynamic where hardware is not really a good business because there's no recurring revenue. In 2020, they decided to leverage some software. Jimmy Neutron over there, Nick Woodman, tried the drones, didn't work, batteries fell out, decided to go for the low-hanging fruit, the software, storage, so you can edit your cameras using like artificial intelligence. It's the buzzword right now, but I think it takes a couple of seconds to edit a video. You can store it and you can pay a small fee. I think it's like $49 a year. So here's where it starts to get really interesting for GoPro. You have a situation now where you have a loyal customer base. And I know there are videos complaining about the cameras online. I'm very much aware of that. But here's the thing. Those videos have been around for a while. You go back to 2010, smartphones were the GoPro killer. You go back to 2016, 17, 18, the rise of Huawei, the rise of Xiaomi, the rise of all these Chinese consumer electronics. They were going to have a cheap knockoff to compete with GoPro. In 2022, 96% of every dollar that was spent on an action camera in the United States went to GoPro. Part of the reason is the products are quite expensive. But that'll tell you how strong the brand is. Could the product improve? Absolutely. But the customer loyalty has been there for a very long time. And there's been doubts about the company for a very long time. They continue to execute. So that I'm keeping an eye on, but it's not something that I'm too concerned about for right now. One more, if we start to see volume slow down significantly for cameras, that might be a concern where consumer preferences might be changing, but that's not something I'm worried about right now. So you have a situation where when inflation started to increase and supply chain started to seize up, they got rid of their low value cameras, focused on their luxury cameras. And what that allowed them to do is reduce the number of stock that they needed to store, the amount of cash that they needed up front for product. And it allowed them to sell to a higher sort of net worth customer, if you want to call it that, with a free subscription to software. It turns out that 1 year free almost always converts with low churn. So we're already at $100 million in ARR with about a 70 or 80% gross margin. So you're looking at about, on the higher end, about 80 million in gross margins that came from pretty much nowhere. It cost 7 million in research and development to come up with this software. It now generates 80 million in gross profits. There is no SG&A. You sell a camera, you get it for free once you register. And then after a year, you start paying for it. So it costs nothing to maintain. It costs nothing to produce. It costs nothing to sell. And it's producing 80 million. So all of a sudden you can realize that the business model is a lot more durable. So hardware is a little bit spotty. It's very cyclical. ARR, annual recurring revenue on software, less cyclical. So the cyclicality of the business goes down. The risk in the business goes down. Cash flow margins increase. We're looking at about a 40% margin relative to previously. I think it was around 30, 32% for context. Software, they're anticipating doubling this, right? So that's the opportunity for growing into the future. Maybe we don't see a huge amount of growth on the top line because the cameras are selling for like $382, $383 average selling price. And this software is selling for like $49 a year. So if you sell less cameras and more software, your revenue is not going to grow as fast as your bottom line because your bottom line has a much bigger margin. And so your cash flow will increase, your profit will increase. So the question comes down to consumer preferences related to product quality. And then secondly, so that's obviously definitely something we need to consider. And then secondly, how big is the market, right? So there are things that I'm thinking about, but it's a company that has net cash. I'd like them to commit a lot more to their buyback program. They're a little bit iffy on it. I'd like them to buy back at these valuations a lot more stock, but we'll see. We'll see how it plays out. I think GoPro is a very interesting, unique business. I think it's very much undervalued, and I'm willing to just be patient. Again, that's why we diversify. Sometimes stuff will work out right away, and sometimes it won't. So Moha, hey Rob, did you discuss how Amazon creeped up to be your third position? Also, as a Canadian, are there any options for us to keep up with my thoughts and positions since we can't make an eToro account? Through the live streams every 2 weeks, I'm planning on doing it, Moha. And if you have any questions, dump it in. And I don't make the videos public right away on YouTube because I'd like to see any comments from people on eToro first. And then after that, I just make them public and see whoever wants to see it. So every 2 weeks. Last week I was away. So with a little bit of travel, I'm not really going to commit to doing them because I don't know what the internet connection is going to be or whether it's going to be a quiet room. So I didn't do it last week, but in 2 weeks from now, we'll do it again. You're saying we have to wait 5 years for T0 to IPO for us to realize the value of our investment in Overstock. I'm down 50% and it's very painful. I have no idea, Teza. I have no idea how long it'll take. What I will tell you is I owned Amoco for 4 years and I was down 30%. The fundamentals didn't change at all. And I bought more. And now the compounded growth rate, I still own this. I own half it. I did sell some of it over here on that spike, but I still own the other half. The compounded growth rate's over 25% at $28. So in October this year, I'll have held this 7 years and it'll compound at 28%, but for 4 years it was down. I have no idea. I thought it was going to play out a lot sooner. Like putting arbitrary numbers on it doesn't make a lot of sense to me. What I know is, certainly from everything I've seen, Overstock's very much undervalued. I have how on earth do you think I would know when T0 is going to IPO? Like I know what the value of the company is. I just have to wait for the market to agree with me. And that's sort of how I approach it. Cameron, there's a couple here. So Don, hi Rob, I have a few questions. Okay. What's my view on gold, silver, and platinum? Do I have any companies on my watch list? Do I still follow Walgreens? I do. Have it in my dividend portfolio, but I'm not convinced anymore. So I think Walgreens is actually very interesting in and around here, and it's definitely like I am watching it. I actually have it on this list here, right here. Present value of cash flows come in at $88. If you go back to last year, present value of cash flows. If you go back to last year, they increased massively their capital expenditure for a new digital platform, for new revenue. Any company that increased capital expenditure last year got absolutely pummeled. So that's ultimately what happened to them last year. Also, every time I speak about Warner Bros. Or Walgreens, everyone seems to note the debt. And so I'm going to make a characterization that I think maybe some people might disagree with me, but the long-term debt's $7.78 billion. And then you've got short-term borrowings in the current portion of long-term debt, which is another about $4 billion. So in total, you have, let's just call it $12 billion. Let's just round it up. $12 billion in debt. Some of it's going to be short-term. That might be refinanced and pushed further out. But it's about $12 billion in debt. We got about $4 billion in cash and another about $4 billion in cash flow. If you go down here, the total debt, because of the way in which we account for debt, it says $36.44 billion, but we know that's not all interest-bearing debt. Some of that is capital leases, which is $22.5 billion. So the debt's not actually as extreme as the $36 billion that the total debt's accounting for. And the reason why I say that is capital leases are very different to debt. Interest-bearing debt, let's say it's the senior note, that has to pay a coupon, which comes out of your net income. Like you exclude out of your earnings, your interest expense. So that's a burden on the business year in, year out until it's paid down. And as well as that, if you can't pay it, there's a lien on assets. So if, let's say you borrowed money to buy a building and you default on that debt, well, maybe they go in and repossess the building. And so you lose the asset if you don't pay the debt. Now with capital leases, it's a little bit different. Let's say I have a lease for 20 years. And let's say I've downsized my business. Do I have to pay that lease for 20 years? Not necessarily. I can renegotiate with the landlord and say, hey, listen, why don't I pay you the next 2 years? And then we break it off. So I pay a penalty, and that might be in the contract. So all of a sudden your capital leases drop massively because you renegotiated. You can't do that with debt. You can't renegotiate with debt. You can't borrow like $1 billion and then come back and say, how about I just pay you back 400 million? How about I give you 440 million and we call it quits? You can't do that, but you can actually go and you can go to a judge and you can negotiate it. You can break specific leases or renegotiate them. So if you look at Zim as an example, they are leasing fleet below market rate, so it's beneficial for them. There's loads of new fleets coming online. Zim and the management have said it. Management can go and speak with the leaser and renegotiate longer contracts with lower rates. And so I don't like including capital leases as debt because it's very different and there's a lot more room to renegotiate if operating problems happen at a business, where that's not the same with debt. And so a lot of people are quoting 36 billion. It's very over-levered. It's not a true reflection of how much debt the business has. This is another one of those examples where the market cap is 31 billion and you could do levered buybacks. If you go over to estimates here and you have a look at its cash flow, somewhere in around 3 billion, 4 billion. And at the same time, they also have a pretty decent stake in AmerisourceBergen. I don't think that they have divested that, but they have a pretty decent stake in AmerisourceBergen. You'll see 150 million here in interest income, or it'll be accounted for income on equity investments, 435 million. Some of that is dividends on Amerisource, which is another very big business. They own a big chunk of AmerisourceBergen, which pays out 1.2%. I don't know how big that position is off the top of my head, but they've got a pretty decent sized position in AmerisourceBergen. And part of that, so what are their assets appraised at? Part of their long-term assets, 3 billion. I think it's probably worth more than that. I don't know. Yeah, well, maybe it's included in there. Trading security, yeah, about a $3 billion stake in it. But anyway, it pays out 1.2% interest on that, and that's factored in here. So if they needed liquidity in the short term to pay down, for argument's sake, current portion of long-term debt, which is 2.8 billion or 1 billion, they have some cash there. They could divest that, and it'd be very easy. It'd be really, really, really easy because AmerisourceBergen is a publicly listed company. It's a $32 billion business. It's a big, 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 big company. Focus list, Ronnie, this is where I'm looking to deploy the 19%. Probably 3-4% of the portfolio into AMOR, 6-7% into Lamentum, maybe like 1-2% into Liberty. And I'm also looking at SCPL, which is a very interesting company. I have some comments on it. SciPlay. So we have a position in Evolution, and the easy money has already been made here, and we're betting on a 30x multiple, which might play out. It might play out, but the easy money's been made. Like, obviously, I didn't anticipate it goes up 33% in like a month, but it did. Easy money's been made. And then you look at the rest of the gaming space. These guys are a little bit different. They have some casino games like slot styles, and those slot style games they're also licensed. So Monopoly, we also own Hasbro. So these guys, well, True Scientific Games, which is the parent company, these guys licensed the Monopoly name for slots and Flintstones and James Bond and Playboy and stuff like that. But it's more casual games like solitaire, bingo, and it's more so they sell virtual coins and chips and cards and stuff like that. And they're not redeemable for cash. So once you purchase it, you're not getting a refund. So sorry, Tez, I had another question there. I'll get back to that in a second, Tesla. So this is also in the gaming space, highly, highly competitive market, really, really, really competitive market. And also it's offered across different platforms like Apple, Google, Facebook, Amazon, Microsoft. Changes in company policy could also impact their business. So it's highly competitive. I don't know if I'd like Evolution is also a competitive market. Let's not mess around. Evolution is also a very much competitive market with, in some cases, lower barriers to entry, but in the sense where anyone can develop studios and compete with them, but they have a unique advantage. So when we're looking at these, they're very competitive. The question is SciPlay at today's prices or maybe a little bit lower better than Evolution? Should I sell Evolution and buy SciPlay? Some of the questions I'm asking myself. It's really interesting. Obviously, they've got their strategy in play. They're investing in existing games, true acquisitions, develop it. Like they made an acquisition, for argument's sake, in a Turkish hyper-casual gaming studio for 107.9 million. They're also buying back 60 million worth of the stock. The interesting thing about this company is it's owned by Light and Wonder, LNW. So Light and Wonder, the parent company, these guys own 81% of the business. And they spun it off back in 2019 to raise some cash. And they still own 81%. They tried to reacquire the shares back in, was it 2021? So in 2019, they spun it off. And in 2021, they wanted to reacquire the shares. It didn't work out because the two chairmen, despite a lot of overlap, they didn't agree terms. But what's very interesting is obviously the chairman's changed, but they're doing a buyback program. This is a $2 billion business. Class A shares is a 19% that's liquid, outstanding shares that are floated that we would potentially buy. And they're buying back 60 million. The market cap of that's only about 360 million. So, it's really interesting where it's not an expensive business, high return on invested capital, very interesting exposure. Some of the competitive advantages is Scientific Games, which is now Light and Wonder, is the parent company, giving them access to their library of 1,500 games. So that access to the library gives them an awful lot of some sort of competitive advantage. But it's an interesting one because if they keep doing buybacks, they're buying back stock, reinvesting, they're spitting money out. It's trading at 10 times earnings. If they keep reinvesting and buying back stock, it will cause a short squeeze. Now, when they approved the 60 million buyback, which I think was last May, they bought back 2.2 million shares on average for 28.4 million or 12.90 a share. And what happened to the shares was really interesting. They popped 50%. Why? It's a short squeeze. I guess the downside would be if there's a tender offer, it's a US company, 81% ownership, and 97% of the voting rights is from Scientific Games. It could screw over investors as well. But I think they would have to pay a premium. So the company has 299 million in cash as well in the bank, and they're just spitting cash out. They're buying back stock, acquiring other companies, 299 million in cash. And there's the potential for a pretty decent buyout from Light and Wonder as well. There is that acquisition opportunity there as well. So that's interesting. I haven't really made a decision on it, but it takes a while to find a company that's undervalued. So SciPlay, just on its valuation, you have to do a little bit of work here. So I go back out here. I think it's in here. There it is there. So you have to do a little bit of work because sometimes when you use these platforms, so SCPL, it just looks too good to be true. So if you look at the market cap, 367 million, that is Class A shares. But there's Class B shares. There's 104 million Class B shares. Enterprise value, 544 million. Yeah, also not a fair reflection of the valuation of the business. Company has no debt, so we got to factor all this in. So the company has, where is it? So the company has zero debt, 299 million, 200,000 cash. It's very profitable, producing a lot of cash. But you got to factor in there's 126,000 outstanding shares. It's a $2 billion business. And if we have a look at its fair value, comes in at 30.92. So the average multiple that we have to get for enterprise value to EBITDA to understand its terminal value, we have to calculate that ourselves. So I've just taken the quarterly average, the annual multiple on a quarterly basis, and I get to the average being 10.18. If you factor that in there, it's coming out at a fair value of about $31, about 91% on the upside. But here's the thing, I wouldn't be buying it. I'd probably want below $14 if I was really to get interested in it. So let's just see what that would look like. If I change this to 14, what are we looking at? Why does that not change? I'm not sure why that didn't change. Doesn't really matter anyway. I'd have to circle around. Change that to 14. Didn't change. Anyway, I'll have a look at it later. Anyway, it would be a much better return. It'd be something like 110 or 115%, something like that. So there's some of the plays that I'm looking at the moment. And at the same time, there's still companies like Amadeus. I want to increase the position. Really interesting play. Really like it. Digital Turbine, the fundamental story here hasn't changed at all. It's very sensitive to the mobile cycle. And there was no way of really knowing just how sensitive, because the last time these guys seen a mobile cycle, which was downturn, which was back in 2015, 2016, I mean, the revenue was peanuts. So you're not going to see just how sensitive it is. So it was kind of sensitive, but cross-selling is also improving. Margins increased from 46 to 50%. That's due to cross-selling. They get the full life cycle of the phone. So Digital Turbine is one. I'm looking at down around 11. I could increase a little bit and then offload as it pushes higher. Baxter, I want to keep buying. I could add a little bit maybe more to Hasbro, but not right away. Tomorrow we have MetaFast reporting. Love MetaFast business. This business is just, these guys have cash literally stuffed in the mattress. They don't know what to do with it. Tons of cash. Increased capital expenditure from 5 million to 40 million. 150 million buyback. Issuing 5.6% dividend. It's just an incredibly profitable business with huge amounts of growth. I really like this one as well. Like the profitability of this across return on assets, capital, equity, gross margins very high, like everything you want to see in a company. It's just a wonderful business. Very unique business as well, because there's a huge flywheel effect. The flywheel effect is somebody goes, gets a coach, takes the supplements, loses weight, buys into it, becomes a coach, takes all their overweight friends into the program. Some of those become coaches, take their friends, and it has this big, massive, it has a huge, massive flywheel effect. And they've been very successful for a very long time. The new CEO came in 2016, and you can see the impact that he had. He was focusing on the coaching, but you can see the impact. Look, 2017 slows down. 2016 it was dead. It was just a supplement type business. Then they factored on coaching, started to turn around 2017, 9.8% growth, 66, 42, 31, 63. Why are we at 4.3%? Capacity. What did they have to do? Increase their capital expenditure, because they didn't have the facilities to manufacture enough supplements. There was a number of different variables. They had to increase their capital expenditure from 5 million to 35. They increased the capital expenditure in 2021 to keep up with capacity. Moderated the capital expenditure to 12.6 million in 2022. Had to increase it again to 40 and next year to 40. These guys are just swimming in cash. They keep hitting their ceilings. So it's only a small business, 1.25 billion, but it's dirt cheap. It really is. For as profitable as it is, and the opportunity that exists, 9 times earnings is just very low. Teza, do I think ICE could instead buy T0 out in the next couple of years and pay us in shares of their own company? It is possible. It absolutely is possible. There would be like a distribution in that scenario. They could buy it out for equity. They could buy it out for equity, and then the distribution would be back to shareholders. Yeah, that is a possibility for sure. But there's many different ways in which we can tap into that value. But here's the thing, like, God forbid if you said that Medici Ventures fundamentals are improving, you'd be ostracized, but they are. There's not many companies that are raising capital. Here's Grain Chain, 29 million. So Teza, you own Grain Chain as well. This is another business that last week raised 29 million. You have a small stake in it, but the general partner who scaled up companies like Red Hat to like a $40 billion valuation invested from their flagship fund 10 million. So we have, it's not just T0. There's a lot of stuff in that basket that is really interesting that could generate decent returns for sure. Okay. what are my views on gold, silver, platinum? No real view on silver or on platinum, but gold anyway. Going back to this view here, if inflation remains higher than rates for the next decade, I think cash is trash, and scarcity is absolutely a factor that you need to consider. Gold has scarcity, an ample amount of scarcity, and I've heard the age-old sort of thesis that the supply of gold increases every year, which is a lot of nonsense. We know how much gold exists in the Earth's crust. The only reason why a lot of it hasn't been mined is because certain gold in the Earth's crust has high all-in sustained costs, and at current prices, it doesn't make sense to mine it. And so the supply of gold coming online is very much dependent on all-in sustained costs like diesel, labor, land leases, if there are land leases, and the price of gold itself. And so we already know how much gold there is in the world. It is scarce. That argument doesn't hold weight. I hold Bitcoin for this reason, but gold is a similar type idea. Bitcoin and gold's on the same bigger macro picture. Yeah, so that's sort of what my view is. So I like gold, bigger picture for sure. PDX I was looking at recently. I'd probably buy the basket. I think in and around here it starts to look interesting. It might go a little bit lower. I haven't got it on my list to buy, but I do think it starts to look a little bit interesting here for gold miners. If you want a little bit more beta, it could generate outperformance, but at the right price. Be looking down around 25, 26. If it got down around there, I'd just go with some of the majors, Agnico. I'd go with something like Barrick, like some of the more boring ones. You can still make a lot of money there. I wouldn't be straying off track and going into juniors, because a lot of those juniors have land and they have no idea. How much gold is there, and they raise money on the premise that it's close to another gold mine, and therefore there's a high probability that they're going to get gold out of it. So I like gold long term. I think I'd be a little bit more tactical and strategical in investing in miners, but I think you could generate outsized returns there. Tesla, if it really is worth more than $1 billion, as Matt Mosman alluded to, then that's good enough for me, as I'm more concerned with the company that Overstock has a higher stake in. So yes, I mean, they've got 84% ownership there, and there is rumor that there is going to be one strategic sale. Could it be BIC Global? It could be, and I'll tell you why. BIC Global is at odds with the rest of the portfolio. Most of that portfolio is like decentralized, more about transparency, whereas BIC Global is CBDC. They're selling central bank digital currencies that can be programmed for, like, for argument's sake, food stamps, all that type of stuff. And so CBDCs are at odds with the rest of the portfolio. They've got contracts with 7 central banks, and they get a commission. It's like a Visa or a MasterCard. I think it could be. I definitely think it could be spun off at a 10-figure valuation, but it's one of these for right now. I can see the value. I can see the opportunity. And the interesting thing is, most people, they don't realize that these companies exist and what they could be worth. The largest adopter of CBDCs in the world is Nigeria, and BIC Global have the contract with the Nigerian central bank, and they get a commission on every single transaction. So yeah, there's a couple of Latin American countries as well. I think it's worth a lot of money. It's a private business, so we really are guessing. We don't with a public business, I could come up with a reasonably good guess. With a private business, a little bit more of a one of these. But yes, I do think it's worth a lot of money. But here's the thing: at today's prices, it's not fairly reflected in the price at all. And the problem is, how do you get the market to wake up to its true value? Do we need to see, here's the thing, let's say BIC Global was spun off or sold, or it was whatever. Let's say it was $1 billion. Do we need to see something like that for the market to realize, wait, there's a whole basket here of companies that are worth more than zero? We should start pricing that in. And this is just the latest example. I really like this company, GrainChain. Been following it for a while. A couple of years ago when I first came across it, I genuinely thought it was a zero. But here we are 2 years later. Big bear market for PE and VC, and these guys are raising 29 million. It's pretty impressive. So I'm not concerned at all, to be honest. My conviction is still incredibly high. It's just time, waiting for the right moment. Cameron, I hope you're well and appreciate your continued knowledge sharing. Thank you very much, Cameron. How am I feeling about Tupperware? Do I feel they're executing well on their turnaround plan? Also, my whole planning to add more, sell or hold a position. Okay, so Tupperware. So let me start off with Transocean. So when I invested in Transocean, it was 1.5 or 2%. But I thought if it played out, I make 10 times my money. I paid 127. The market cap was 650 million. Now from 127 to the current price, I added some more, so my average cost is higher, but I just want to. So my view was you're not going to make 10 times your money unless there's a level of risk that the market can't figure out. So the market cap is up 450%, let's call it. I bought it at 650 million. Sorry, the share price is up 450%, but the market cap's trading at 5 billion. So if I take up my calculator, you guys won't see this, but if I take my calculator, which is 5,000 divided by 650, the shares outstanding are up about 770%. The difference is obviously dilution. But when I invested in this, there was a real chance that this could go bankrupt. So I invested in it with a small amount. There was a chance it could go to zero. There's a chance it could go up 10x. Fortunately, it's moving in my favor. As we continue to push forward, they had enough of money. They issued it. The equity outstanding shares increased. Fine. They were able to service some of their short-term liabilities, refinance their debt. All of a sudden, there's no longer risk of bankruptcy. What do you do in this phase here where the fundamentals continue to improve? Longer-term contracts mean that there's going to be stronger cash flow for a longer period of time. Well, you increase your position. And so with Tupperware, there's a turnaround play going on. You start off with a small position and you wait for those clear signs, and you can make a lot of money if it works in your favor. So in this case, it's been quite volatile. I think we had 2%. I don't know. I'll have a look now. I think we had 2%. We had 1.64%, down 53% on that. But you start small because the risk is quite high. And then as the fundamentals start improving, you increase your position, get your average cost lower, and that's where you make all your money. So with Tupperware, first question there was, is the turnaround going well? It's not. It hasn't been going well at all. There was more questions than that. The turnaround hasn't been going well at all. And in the last quarter, on the last quarter, Don went over gold, silver, platinum already. I'm not sure if you heard it. In the last quarter, the problem was, if we go to TUP, investor relations, why did the share price drop? Well, before their earnings come out, which is what, on the 1st, it's 10 days away. Let's just have a look at its financials, and then I'll give you a little bit of perspective in a second. 102 million, 103 million in and around that region. And they have close to 700 million in debt. Not exactly 700 million, pretty much in debt. So they have 700 million in debt, 100 million in cash, and here's why the share price dropped. So if we go back to earnings release for Q3, I think it was this one. Anyway, leveraging, they need to get their leverage down because of covenants on the debt. So the problem is you start doing bad deals. Let me just find it for you. We're excited. So I think the reason why it dropped was the covenants on the debt that they have means that they need to get their leverage down. It's here somewhere. Additionally, currency headwinds, no, partially offset. We faced internal and external challenges. Maybe it's down a little bit further. Net sales driven by, higher resin prices were a problem. So commodity prices. They have to, anyway, it's here somewhere. I think it was definitely this report. They have to get their leverage. They have to get their leverage lower. I think it was Yeah, they have to get there. There it is there. Consolidated net leverage was 4.17 with the 4.5 debt covenant limited for the quarter. So they needed to get their leverage down. That was on a non-GAAP basis. So if they get their leverage down, it means that maybe they have to pay back debt or something like that. But that's why the share price dropped, because it's probably going to be a drain on cash. If you look at the accounts receivables, you've got about just shy of 100 million. And if you look at the payables plus accrued expenses, you've got like 340 million. So you need to get your leverage down. At the same time, your receivables versus your payables is massively out of balance. And a lot of retailers are seeing a huge bump in inventory. That's not the case here. So you can't even liquidate a lot of your inventory. So that's really what happened in the last quarter. I'm hoping for a fantastic Q4. And if there is a fantastic Q4, I mean, if you've seen the last reaction to price, it was up 65% in a day. And the reason being, it was slightly better than expectations. So we'll see what happens on the next quarter. Maybe they pay down a little bit of debt, better than expected performance, and we'll see what happens with the equity price. But there is still a chance they can turn it around, like in the case with Transocean. And in those examples, the share price can run like 10x. So with Transocean, I was down on my original position 50% before it started to run up. 127 wasn't the low. So you do take on a lot of volatility, but if you're right, you make a hell of a lot of money. So 127 was somewhere in and around here. You feel like a genius when it shoots higher like that, but equally you feel like a dumbass when you're down 50%. So anyway, that's the sort of scenario with Tupperware. If we start to see a bit of a turnaround in positive direction fundamentally, we'll press it. As of right now, I think present value of cash flows factoring in all the debt and the interest expense is actually pretty high, but the covenants on the debt's kind of screwing them over. It's $23 is what's coming out as the present value of cash flow, but there's a lot of risk in that. It's not as, there's a reason why we're discounted to 75+%. So I think that's it. If anyone else has any questions, fire away. We went for the 2-hour mark, but I just wanted to keep in touch with you guys and share sort of where we are in terms of the portfolio changes. Somebody asked a question, I think, on, did I see a question on IDS? Oh, here it is here. So yeah, we went to, okay, so did I miss this? Yeah, I missed this. Thought process behind closing, went over that. Okay, ideas for cash pile, went over that as well. Focus list. How much does the 6-month extra industrial action change the thesis with Royal Mail? I think the margin of safety is huge here, but bleeding over time. So yeah, when you look at Royal Mail, it's important to understand it's two businesses. So there's the UK operations and then there's international operations. So international operations is GLS, and then they also own a train network or train rail line over in Canada as well. But they have international operations, let's call that GLS, and then you have Royal Mail. So if you take the net income last year of GLS and you divide it by the current total enterprise value, you get 4.81 times. So that's just for GLS. On the earnings report, management came out and said, look, if we can't get a deal with the unions, we're going to spin off Royal Mail. If they spun it off for zero and they took all the debt out of the business associated with Royal Mail, all of those liabilities with it, we're probably trading at 2 times enterprise value to EBITDA, maybe a little bit more for GLS alone. It's dirt cheap. This is incredibly profitable, adapted really well throughout higher inflation. It's a really great business that it's hard because the name used to be Royal Mail, and so everyone assumed it was all one company, but that's why they changed it to International Distribution Services, to understand that it's 2 separate businesses. So if you cut one off, it's like a Siamese twin at the moment. If you cut one off and the other one stays alive, you make a lot of money. Or the other one, there's some sort of concessions with the unions. With the unions, management went back into that conversation. I don't know why they done that, because then they were open to negotiation. I don't know why they done that. I thought they played a really good move in saying, listen, we're going to spin off the business, and then private equity are going to come in. 80% of staff are going to be fired. Most of the letter routes are going to be scaled back. Private equity are just going to get the cash flow. The business will be pared back to a tiny little shell of itself with barely any staff. Well, not barely any staff, but a lot less staff. And so when they came out and said that, the market started moving. The initial reaction was very positive. It was up about 50% off the lows. And then it kind of fell back a bit, rallied back up. And then it was recently, so that there, it was on like the 6th of February. I think they opened the conversation with the unions again. So I don't know. I agree that the fair value of the business, there's a huge margin of safety. But it's what does the market see? It might take a little bit of time. That's why we diversify. I noticed that some of your positions might be from ideas on Value Investors Club. No, I'm not actually there. I'm not on Value Investors Club. I don't know how to get into it. I see people talking about it, but I don't know how to get into it. How much am I using this and other resources? I don't use any resources that like other write-ups. I use one resource called SEC and 10K filings. So let's say like a recent acquisition. I go through annual reports and I get an idea of what the business does, segment it, take notes, understand the business, try and figure out whether it's a business I can understand first and foremost, if it's easy to understand, break it all down, usually into like a one-pager like this. And I come up with sort of a fundamental thesis that I derive. And then I try and figure out where the weaknesses are. So you'll see like in this, I've got some notes, risk here. And then also this here, the ownership structure is also a massive risk. So I like to put it like the downside risk. And I also like to put the upside risk. And then just understanding what the business does. And then that'll give me a grasp or a framework. If things start to go south, I know what the obvious problems are, the ones that are most likely to go wrong. Hopefully I'll be able to spot it quickly. If things don't go south and the share price just drops, I just add more. So I usually do that. I just spend all day going over, different companies that look interesting. And I write up one-pagers. I don't like them to be very complicated. Baxter, Amadeus, stuff like that. And then I figure out, like I've got loads of these spreadsheets where I spend figuring out present value of cash flows. And then after that, I look at charts, and then I consider a number of different variables like bigger picture. So if you look at Alpha Metallurgic, I'm then interested in the macro. Okay, these guys are in the steel industry with the biggest customer being India. Okay, what's steel like forecasted for 2023? Okay, that might give them a little bit of a cushion because it's actually a growth market. And then I decide to myself, how much I want to allocate to it, etc. But I'm not on Value Investors Club, and to be honest, I don't know if I'd want to be on it. I'm sure there's fantastic stuff there, but sometimes I feel like when I read other people's analysis, I get a little bit more lazy and I take it as gospel and I don't go over the stuff myself. So I don't know. I don't know. Maybe I'll go on. Maybe I'll apply. I don't know how you apply, to be honest, but that's what I use. Like I spend a lot of time in Ticker Terminal. As I mentioned a moment ago, you got to be careful with the outstanding shares, different classes of shares. So the valuations might be different, a little bit different. I'll give you an example. If you look at this here, if you were to look at enterprise value to EBITDA, it looks bizarre. But if you look at enterprise value, or if you look at price to earnings, it doesn't look bizarre. And I'll show you why. It's down to how it's accounted for. So if you look at valuations, enterprise value to EBITDA, 2.6, hardly. Price to earnings, 10, more reasonable. It is actually 10. And the reason being is, when you pop on over here, you can see if you understand your way through the financial statements, you'll see different parts of these statements, like for argument's sake, valuations, like how is the enterprise value 2.6 when it's not a company that has like huge depreciation and amortization or anything like that. It's not like a midstream operation. So how is enterprise value to EBITDA 2.6? And then you have like price earnings at 10. Well, if you go over to financials very quickly, you go down here to minority interest, you see 93 million. they have a parent company. And then you dig a little bit deeper into the weeds and you pop on over here to the SEC website and you have a look at their, maybe you should start here to be honest, but you go through their annual report and you realize that, anyway, you realize that the parent company is an 81% owner. So Light and Wonder is the, yeah, there it is there. Light and Wonder. Scientific Games, LNW. So that's their non-controlling interest. They have 97% voting rights. So that's what I do. And some people might find it boring, but I just keep repeating the same thing over and over and over. And sometimes I find some gems, and sometimes it's just nothing. So I look at high return on invested capital businesses and I keep an eye on these. I also keep an eye on the charts. So I've got 20% ROI. I keep going over these, looking for beaten down opportunities and highly profitable businesses. So I just do this. That's what I do all day, and hope that I find maybe one or two good ones. And then I have this sheet here, which I look at price to earnings, and this is the high return on invested capital one, where I've got all the price to earnings. I've got its growth rates, intrinsic value, what the margin of safety is. I just pluck that. Okay, let's have a look at Amgen. Just go a little bit further from there. So that's it. Is there anything else I missed? Let me just have another look. Minimum copy, I answered that. Digital Turbine, I missed this one. Don't know how I missed this one. What's my view on the poor earnings and outlook for Digital Turbine? So Digital Turbine's earnings were disappointing for sure. And they were disappointing because, to be honest, I think it actually just caught the management off guard as well. The mobile phone cycle slowed down 12% last year, ex-Apple. So these guys are on Android. And they're quite sensitive to it. The one thing that I found quite interesting is that the margins expanded. So you listen to the CEO. This is the first time Bill Stone, who's the CEO, does a good job at explaining the business. And he goes over like cross-selling starting to ramp up and how cross-selling is expanding their margins. So the margins are going from 46%. So non-GAAP gross profit margins were 50 up from 46. Cross-selling is giving them, if you want to listen to what he had to say, cross-selling was giving them an opportunity to make money on the whole life cycle of a phone. So in the future, they won't be, that's factoring in the 3 acquisitions that they made last year, but they won't be as dependent on every time a phone sells, they'll have pre-downloaded apps on it, and that's it. You don't get one-time revenue. Now you'll get, for the lifetime cycle of the phone, you'll be able to make revenue from the 3 acquisitions last year. Single tap, I think, is also a big opportunity. It's going to be a little bit slower to roll out, but the framework of the business is still pretty solid. And so this is not a very big business. They do have a little bit of debt, but they paid down, I think, something like, is it 100? Let's have a look. I think it's 100 million or 80 million in debt in the last 3 quarters, which is pretty good for a $1.2 billion business. It's about 6-7% of its market cap in 3 quarters, not even a year. They've paid down in debt since the acquisition. So they're very cash flow positive. They're making strategic decisions to de-risk the business. It spits out cash flow. So you can see 60, 25, and 43. So they've paid back 126 million since June quarter last year. It's pretty damn good. Well, they refinanced 18. So sorry, there's about 110 million debt reduction since the June quarter last year. It's only like 2-3 quarters. So they're taking all the cash flow, reducing the debt. Enterprise value comes down a bit. Systemic risk within the business is a lot lower. It's a very asset-light business, and it's still very, very, very young. So there is going to be there's going to be, to some degree, some volatility in its business. But I still really like the opportunity in Digital Turbine. I really do. And it's not like the earnings are so terrible that I need to get out. Like, this is a company that's cash flow positive, trading at 10 times cash flows. And it should recover if mobile phone cycle picks up. You'll start to see upgrades midway through this year. As of right now, with the downgrades, it's fair value somewhere around $25, $26. But I'd argue that there's just not a lot of analysts actually looking at it. So the consensus average is sample size of like 2 or 3. Will I also consider increasing Zim, Overstock, and Warner Bros? Yes, and no. So with Zim, I looked at Zim, and I like Zim as a value play, and we're making money on Zim. After the dividend, I'm factoring in the tax on the dividend. The average cost is somewhere around $20.50. So we're making a little bit of money. The liquidity of the business per share, like the cash per share, is around $35 per share. So I was thinking, with China reopening, Zim is a business that has 34% of their volume through the Pacific Ocean. Pacific connects California and China. And so with China reopening, you will start to see that volume, the demand in the Pacific Ocean there would start to pick up a little bit at least. And the fall in terms of freight rates would slow down. That's sort of what my view was. I also think they have a fantastic competitive advantage because they don't have any, well, they have very little debt. It's like, I don't know, 180, 190 million. And most of it's capital leases. And they've said a number of times that what they'll look to do is renegotiate those capital leases. So if we have a look at Zim today, they have below market average lease rates. So even though the number of ships are increasing, they don't own them, they're leasing them. And they're leasing LNG ships. So they're more ESG friendly, more efficient in terms of the amount of fuel that it burns. And they're paying below market rates for it because there is a massive sort of sea of new builds coming online. So they have, long-term investments. It's also important to look at short-term investments. Long-term investments are likely treasuries. So there's a lot of liquidity there, which generates interest income. When you're having a look at its liabilities, the debt is 140 plus 99. So you're looking at about 240. They probably pay down the just shy of 100 million debt. And then because they've got 3.1 billion in short-term cash. So they probably just pay that down and leave it. And there's 140 million left over. And the rest is capital leases, which can be renegotiated. Here's the thing. And this is why. So if you look at... 7 days ago, Barclays downgraded Zim, and I'm reading this in disbelief. The guy, this analyst, must be straight out of school with not a lot of experience because there's a lot of mistakes in this analysis. His target price is assuming there's going to be $1 billion loss next year, and the target price is $15. And no doubt that impacted the share price on the day. The reason why I don't care about these analysts is because you have JP Morgan who got it right. JP Morgan upgraded it like 2 days ago, and they actually got the fundamentals right. And they upgraded their price target from 17 to 30. So these guys upgraded it. So 7 days ago, you have Barclays saying it's worth 15, and they downgraded their estimates from like 30 down to 15. And then 3 days later, you have another analyst saying it's not worth 17, it's worth 30. I think the guy over at Barclays has a lot of mistakes in his analysis. And I think JP Morgan got it right. They recognized that the capital leases are below market average. The shipping rates are probably not like we're probably getting closer to, like, there it is there. Look, Barclays, literally within a couple of days of each other, 4 days of each other. One investment bank from 26.50 down to 15, the other one from 17 up to 30. It's comical. So my plan all along was get in around $20, play it up to about $35, $40. That was my plan all along, and that's what I'm sticking to as of right now. So I don't want to add any more. I just want to let it run. Okay, done that. T0. Okay, I really do think we're at the end now. So yeah, this is a lot of commentary on individual positions. So maybe this isn't. Sorry. Would I say capital is coming back into the economy now? So the Bank of Japan and the People's Bank of China eased a lot. It's not sustainable at the rate at which they're easing, and it's probably going to taper off soon. So we're probably going to get a bit of a correction. But yeah, a lot of liquidity came back, not from the US central bank, but from the Bank of Japan and the People's Bank of China. Not sustainable, but we also kind of know where the neutral rate is. And we've gone from the conversation of rate hikes into infinity. We're going to get 10% on the, we kind of know where the neutral rate's going to land, plus or minus 25 basis points. So it's more about, okay, how long does it stay at this level? I don't think it's going to stay long, but some people think it's going to be higher for longer. So we're already at the point at which we're starting to know where the peak for, or the bottom for US Federal Reserve liquidity is. It's also important to note that the RRP, so if we have a look at, RRP, so this is the overnight repurchase agreement. And so the Fed funds rate is the overnight rate. Let's say it's 5%. The Federal Reserve would have to pay out $100 billion a year in interest expense. Where does that money come from? Where does the Federal Reserve get that from? That's quantitative easing. So we do have like $2 trillion in RRP, which is producing just shy of like $100 billion a year. We also have the TGA, which is drawn down about $500 billion. It's drawn down about $500 billion, but it's still about $490 billion there. So there is like, it's not as tight as what a lot of people think. You're seeing tapering, yes, but you're also seeing quantitative easing, which is a weird dynamic to pay the interest coupon on the overnight repurchase agreements. And then you also have the government's bank account, which has $490 billion in it. So there's a little bit of liquidity there. There has been a flow of liquidity out of the government's bank into the economy, which has been supportive. So we have seen liquidity turn, yes, and that's why asset prices have been supportive. How long does it last? That's a good question. It's not sustainable what the Bank of Japan and People's Bank of China done. So this one here was, especially now that 80% of Americans believe we are heading into a recession. In other words, so recessions are inevitable. Figuring out when the recession happens is the $1 million question. So when someone calls a recession, it's not really a brave call. If somebody called a recession last year, it would be a brave call to say, no, we won't see a recession. And we didn't see a recession last year. The fundamentals really didn't support it. And I think that became more apparent today. I think that we're in a period of slow growth. We'll reassess at the end of the year, but it's slowing. That growth is slowing down. It's not speeding up. It is slowing down. Do I think it's a good time to be fully invested, or should one have 10 to 20%? Look, there's a lot of companies that have good margins of safety. We're in a slow growth environment. We're not in a no growth environment. And liquidity is, as you've seen, as you pointed out here, liquidity has eased somewhat. Next will be US central bank. And I think that there's still a chance. I think there's still a chance that we have a sort of 1994, 1995 type environment where you have an activist Fed, and then you start to see cuts, but you don't see a recession. And then you see a couple of cuts for a couple of years and the cycle kind of extends. I still think that's a possibility. Now, people would argue we didn't have inflation back then. Yeah, but you can't fight inflation today either because you have a shortage of labor. And unless the Federal Reserve have human printers for the labor market and can age them 18 years overnight, it's not practical. And sure, you're hearing in the news about all of these different job losses in the tech sector, but you're not hearing about all the constraints in other sectors. Like, why is Amazon paying $15 an hour? Why is Target paying $14 an hour? Not because of minimum wages, not because of ESG, not because of any of these factors, because they can't get enough labor. Why is construction so far behind on labor? Job openings for construction, I mean broad construction, I don't mean just residential real estate, but NFP, total construction, all employees construction, no job openings. So this is obviously growing. So you can see there's big massive growth here. Jobs, was pretty high. I haven't looked at it in a while, but it's still pretty elevated. Yeah, it's even growing again. So you have 413,000 jobs listings for construction workers alone in the US. So we're talking about like 100,000 tech jobs lost. We're at pretty close to an all-time high in terms of job openings for construction at 413,000 alone. If I go JOLTS, what other industries? Like manufacturing is coming down, but still 764,000 job openings. There's some people arguing that the way in which we account for this is incorrect. Maybe not, I'm not sure. Information should become, information is more like Google. It's more like Facebook, stuff like that. Ronnie's asking, do I think viewing 13F from super investors is a waste of time? Well, look, you're viewing old information, and it might give you a lead into a good company. Maybe so there's a couple of things with investing. High fail rate. So just because you're a super investor doesn't mean you can't lose money on an investment. That's why diversification is important. So there is a high fail rate. If you're following somebody into a position on 13F, you're 3 months late. And as well as that, why did they buy it? Do they own the underlying equity and have a big, massive put position, right? Do they have some sort of position short the credit that they don't disclose? Like maybe they disclose puts, but maybe they don't disclose default swaps on the credit. Maybe they don't disclose whatever it may be on the credit side. And so like, what's the point looking at a 13F filing? You've got zero context into what the expectation is. What if it's a long short? What if the idea is to make the spread? So what's the point looking at 13F? Okay, you can see what, in hindsight, how somebody performed, decisions that they made, all that type of stuff. Great. There is some value in that, but not towards allocating capital. And I personally just don't have time to, like, I have 19% cash. Like, where the hell am I going to put it? So all day I've got to figure out where am I going to put that cash. So looking at 13F filings is not going to solve that problem for me. It's going to give me delayed data, no context into the position. So I personally, and I'm not saying it's a bad strategy. Some people probably make a lot of money doing that, but for me, I don't. It just doesn't work. It wouldn't work for me. I know it wouldn't work for me. So I don't do it. But that's not to say that there's not, again, that's not to say that there's not value in it. I just don't. I don't get any value out of it. Okay, I think we're really at the end now. So unless any of you guys have some questions, fire away. If not, I think we'll end it there. Ronnie, you're very welcome. Okay, guys, I'm going to leave it there. We're over 2.5 hours in. We'll do another one maybe in 2 weeks, every 2 weeks. And yeah, looking forward to it. So got quite a bit of a cash balance to get to work. And yeah, looking forward to it. So have a great day, everyone. Really appreciate your support, and we'll catch up soon.